I think growth has surprised to the upside since the election. It's just harder and harder to justify owning non-U.S. developed markets.
Returns have really been driven by a narrow collection of stocks. Narrow stock leadership is fragile stock leadership.
There's clearly this awakening of animal spirits. The attitudes from the sell side today are remarkably different than they were a year ago.
There's enormous optimism about the U.S., but we don't know about what this new administration is going to do.
Sentiment is very positive, but I think sentiment is positive for a reason. You know, the economic growth's been surprising to the upside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. Bloomberg Surveillance starts right now with equity futures on the S&P 500 just short of all-time highs and pulling back by 0.25%. Going into US retail sales later on this morning at 8:30 Eastern Time. Then the big one tomorrow afternoon. The Federal Reserve decides at a Chairman Powell news conference. The sentiment sky high. Bank of America Global Fund Manager Survey. Sentiment is now super bullish. Cash allocation is at a record high. And Lisa, US equity allocation is at a record high. So cash allocation record low, rather. Equity allocation record high. We are super bullish right now.
So what do you do with that? And that ultimately is the question. Michael Hartnett over at Bank of America said this is the second contrarian sell signal in 3 months because the allocation to cash at 4% is this record low. There is a question, though, about whether we've seen this movie before, and it actually is really rosy for the following year. And when you talk about bad breath, that's actually not necessarily a negative signal. So everyone's talking about that as basically people lean into this bullishness as opposed to really moving against it.
Do you want some negativity? Governments falling in France, in Germany, Canada and Trudeau on the brink. Check out the Canadian dollar. Weaker once again. Levels we haven't seen going back to 2020 following disagreement with his finance minister. Trudeau is almost flying solo.
Almost. He's literally hanging on to his political life. He's been in power for 9 years, and you have a stunning falling out between the finance minister. And this has to do with really the deficit and how to control the deficit in Canada. Behind the scenes, there was a lot of disagreement on checks they were maybe going to send out to Canadians, some tax breaks around the holiday season. But the crux of it comes at the time when Trump is talking about more tariffs with Canada, and these two disagreeing members of his own party say enough is enough. I think you have to go.
The parallels between what's happening in Germany and what's happening in Canada are really remarkable. Olaf Scholz firing his finance minister and then getting that no confidence vote and having to hold early elections. And then the Canadian finance minister resigning over, guess what, budget issues, over how to respond to the tariff pressures, as Anne-Marie, you were mentioning, from Donald Trump. It raises this question about whether Justin Trudeau can last until the next election time. There is something happening. And I think that it is notable that in these two developed markets, there is something so similar unfolding with the finance minister pressuring the top of the ticket.
Go back to June and go back to the G7 meeting in the south of Italy and have a look at the picture and ask yourself who's going to be left over the next few months. The leaders of Britain, Japan, gone. The US, Biden, going. Macron under pressure. Scholz basically triggering an election. Trudeau. Time is up. Look at the polls. We're talking about a 20-point gap between his party and the Conservatives. The only person still standing with any strength is Giorgia Meloni of Italy.
And at the time when I was in Puglia, we were talking about that. It was all of these men coming to the south of Italy, to Puglia, to meet basically the Principessa now of Europe, the individual we knew who would be really the main speaker representing Europe, dealing with the incoming administration ahead of that U.S. election. Politico that week called it the Last Supper, and they couldn't have been more correct.
More on that story a little bit later this hour. Coming up, we'll catch up with Katrina Dudley of Franklin Templeton, seeing a supportive backdrop for equities. Bloomberg's Mike Shepard on Trump's meeting with the TikTok CEO, and Mark McCormick of TD with Canada's government very much on the brink. We begin this hour with stocks taking a bit of a breather ahead of fresh US data at 8:30 Eastern Time and a Fed rate decision tomorrow afternoon. Katrina Dudley of Franklin Templeton is optimistic heading into next year. The current market environment is a function of animal spirits following Donald Trump's victory and market liquidity that is supportive. Strong market performance was historically not a reason to be bearish. Katrina joins us now for more. Katrina, good morning.
Good morning.
It's good to see you. Massive underperformance so far in the month of December for the equal weight S&P, for the small caps on the Russell. Underperformance for them, outperformance for a market cap S&P, particularly for the Nasdaq 100. What do you think is going on at the moment?
Look, I think at the moment we have had a period of digestion. You've had the change in the administration. We've had this, as we talk about, this rekindling of animal spirits. And so I think that what we're looking at is what can happen going forward in 2025. We think pretty much 2024. We're at the tail end. People are checking out, going on vacation. So where are we setting up for 2025? I think that's the most important thing. What we do need to see, though, is the breadth in the market expand. And we've been talking about this for a long period of time. But I think that we need to see that breadth work for the market in 2025, or you're not going to sustain it.
Expectations for the United States seem to be sky high. We went through the Bank of America Fund Manager Survey, cash allocation record low, allocation to US equities record high. The bar for Europe is so much lower. A question we've asked around the table quite a few times: how little needs to go right in Europe to change that story?
You know, I grew up as a European fund manager, and I've been bullish on European equities for my entire career. Not exactly the best decision in my career-wise. What do I think is happening? Europe is just the US's poor cousin. We just started the conversation with how much turmoil we're having across the region in terms of the top of the house and the transition that you're having across various different markets. If you look, however, the market is cheap. But cheapness now, we found out, is not a reason to go long equities. It's not a reason to suddenly go all in. They've done the 25 basis point rate cut, which is positive. They have also got the cheap valuation that I mentioned. The market is also underperformed. Inflation there is actually under control. It's under the long-term target. The question is, what is the catalyst? They don't have the tech engine, the AI engine that we have here in the United States. On terms of the labor market, you've got a stable labor market, but it's not an energized labor market. So the question is, even though all of these factors are positive, what is the catalyst to drive the market? And I can't find one yet.
What about rate cuts? I mean, this is basically one of the arguments, is that if you follow the rate cutting cycle, that'll take you to Europe much more than, say, the U.S., at least with certainty.
Yes, I think in terms of the rate cut cycle within the U.S., given where we're looking at some of the inflationary policies and what we expect on the horizon, what we're seeing in terms of our deficits, we're not as optimistic as the market has been about further rate cuts here. As you see, however, in Europe, rate cuts are not necessarily a driver of market performance, particularly if you're cutting rates in order to generate economic growth. So you're actually cutting rates in response to weakness. It's a very different story than we saw in the United States, where the rate cuts were really more of just tinkering around the edges and adjustments. So I can't put my hat and look at and saying to a European investor, they're going to cut rates. That's the reason you want to own equities. You need an underlying story. And Europe needs to get back its animal spirits somehow.
Right, and I think a lot of people are trying to figure that out. You were saying that in order for the thesis that you have, this sort of bullish American exceptionalism story to bear out, you need to see breadth get better.
Yeah.
And we've seen pretty bad breadth. And I keep thinking about the other way to read that every time I say that. But Max Kettner of HSBC said, we've previously found breadth to be a poor timing signal. Why is it important to you? And at what point do you change your bullishness based on that?
I think the reason is that we don't want to over-index to just so few stocks. So I think that that's the first indicator of breadth. The second thing is, if I look at what has driven that top part of this market, those magnificent seven, it has been AI, and it is really being AI fuel growth. The second stage of AI is actually AI permeating businesses throughout multiple lenses. So if I look at it, the first element, from our business point of view, is just our own back office and the ability of AI to help us serve our customers better, get better data on them, meet their needs more quickly. The second element of AI for us is obviously from the investment lens, where we're looking to invest in other companies. And then the third element of AI is how we permeate it through actually making better investment decisions. So how do we control better for risk? How do we identify trends? How do we look at unintended correlations? And I think that that's the three-pillar part of AI is what's going to drive the next part of the market. It's this idea that AI isn't just a one-man band or one-person band here. It is really going to start moving into the kind of mid-caps and the upper end of the larger caps.
Can that happen next year if the Fed finishes their rate-cutting cycle?
Yes. I think that the Fed is going to be pretty much done. I have a look at some of the notes. We have been on the end. We have been fairly much in the camp that rates will be higher, that the rate cutting cycle would stop much earlier than the market is expected, and I think the market's moved to our position. We are looking at federal deficits. I think as we go into the next year, you need to have a look. People are bearish. So why are they bearish? Well, they're bearish because the market's done so well.
Well, great. T. Rowe Price is talking about potentially even 10-year yield hitting 6%. At that point, when does that start to eat into equities?
In terms of why would it eat into equities, obviously, if you have that long end of the market where you've got a ton of value sitting in the long end, you've got over-leveraged companies, that's where the rates are going to hit you again. But if I take a look at that type of narrative, what you're basically saying is that the fiscal deficit is going to destroy America. And I just cannot see that. I have a look at what's happening. I have a look at everything that's been done to address our costs. And I think that America has still got a very good narrative. So I think we can adjust to those type of yield numbers. I think what we're more adjusting to is the fact that the yields, the rate cutting cycle is pretty much at the end of it. It's done.
Neil Dutta of Renmac just publishing, Lisa, concern dollar's gone up. His concern is going up just a little bit. 2 years ago, back in 2022, he recalls the consensus was largely on the recession train for the coming year. He took the other side. Today, the consensus is fairly sanguine on growth next year. However, labour markets have been cooling. I see myself on the more cautious side of the consensus at present. There is a bit of pushback out there regarding the labour market, if not the deficit.
Never thought that Neil Dutta and Andrew Hollenhorst would be besties, but that seems to be the case. And it does seem like there is this feeling. Maybe guys stop with a sense of everyone's doing just fine, because you do see cooling, you do see a sense of that stagnation reaching a tipping point when it comes to the mobility in the labour markets.
More data coming a little bit later, 8:30 Eastern time. We get US retail sales. Katrina, good to see you. It's good to catch up. Thanks for dropping by. Katrina Dudley there of Franklin Templeton. With an update on stories elsewhere this morning, let's cross over to Bloomberg's Danny Berger with your Bloomberg Brief. Hey, Danny.
Hey, John. Ukraine has claimed responsibility for the assassination of a Russian general in a bomb attack in Moscow. According to a person familiar, Ukraine's security service carried out the killing of Lieutenant General Igor Kirilov and his assistant. Russia said the two servicemen died when an explosive device planted on a scooter detonated near the entrance to an apartment building. Investigators have opened a criminal case for murder. The New York Police Department is calling on Congress to grant local authorities the power to neutralize the drones that have been spotted flying around the Northeast. The NYPD says the inability to act leaves the city vulnerable. Over the weekend, the NYPD received 121 drone-related reports. That is more than the total for all of November. The EU is opening an investigation into TikTok over its handling of the Romanian elections. It cited concerns about fake accounts and foreign interference. The probe examines whether TikTok failed to prevent manipulation of its recommendation system and properly labeled political content. TikTok then provided information on its efforts to address election challenges and updated its in-app election center to the link of an official Electoral Commission's website. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, a warm spot for TikTok.
We'll take a look at TikTok. You know, I have a warm spot in my heart for TikTok because I won youth by 34 points. And there are those that say that TikTok has something to do with that.
That conversation up next, live from New York City this morning. Good morning. Another bull with a bullish price target on the S&P 500 for next year. Julian Emmanuel of Evercore looking for 6,800. One of the most bullish right now, John Stolfus of Oppenheimer, looking for 7,100. Equity futures right now in the S&P pulling back by 0.25%, really echoing that sentiment that we've seen across the board on Wall Street. The fund manager survey out of Bank of America this morning. Record low cash allocation, record high allocation to US equities. We're seeing this on repeat, Bramo, time and time again over the past few weeks.
The question a lot of people have is, what do you do with this? All right, Michael Hartnett of Bank of America is saying that there is a contrarian sell signal from some of this overwhelming bullishness that led cash to the lowest levels. But Max Kettner, echoing a little bit of what we just heard, basically saying that their biggest pushback from their bullish call, two things. Valuations are too high and everyone's bullish. Is that enough of a reason to get bearish?
You can sense they're uncomfortably bullish.
Yes.
Can't you? A lot of people that come on this program just do not want to be bearish going into 25.
How can they be? At a certain point, everyone's talking about the potential for rate cuts, albeit maybe just a few more, the idea of lower taxes, and then there are all the potential headwinds, but you don't see those yet. So people are saying you can't lean against it. You can feel that reticence just in a lack of breath in the market.
And that's Nasdaq 100 record high, S&P 500 pulling back a touch. We're down about 0.2%. Under surveillance this morning, a warm spot for TikTok.
We'll take a look at TikTok. You know, I have a warm spot in my heart for TikTok because I won youth by 34 points. And there are those that say that TikTok has something to do with it. TikTok had an impact, and so we're taking a look at it.
So here's the latest this morning. TikTok CEO meeting President-elect Donald Trump at Mar-a-Lago just weeks before the app is set to be banned. Trump making favourable comments about TikTok as the social media company asked the Supreme Court to block the ban. Bloomberg's Mike Shepard joins us now from the nation's capital for more. Shep, it's good to see you, sir. What does the calendar look like for this social media app?
Well, the clock is really ticking on the company right now. They face this existential threat as soon as January 19th, and this is when that divest or ban law goes into effect. It requires TikTok's Chinese owner, ByteDance Limited, to sell the company to a U.S.-friendly buyer by that date, or it faces a ban. And what that means is that app stores may no longer service it, and its accessibility via VPNs could also be targeted by U.S. authorities. Now, all that could change under a Trump administration, potentially, because they will be the ones largely charged with enforcing it. So Trump's signals of a warm feeling for TikTok could suggest that he may ask his Justice Department perhaps to go a little bit easier on the app as this enforcement goes into place, or perhaps he even goes back to Congress to ask for some sort of a repeal of this law. However, there is a big asterisk there, John, and that is that there is a law on the books. It was written very airtight following the rejection of the ban of TikTok that Donald Trump tried to put in while he was in office. Remember, these warm feelings are a bit new to the president. And two, lawmakers really rallied behind banning TikTok. It was an overwhelming vote in favor of doing so. And it will be tough to imagine them simply accepting that the law that they passed and had President Joe Biden sign simply be ignored by Biden's successor.
Well, Shep, not just any lawmakers. We're talking about Senator Marco Rubio, who's been talking about Chinese espionage in TikTok since 2019. How divided is the transition team right now about this app?
We're not getting too much of a window inside the room into their thinking, but you're right, Anne-Marie, to bring that up, because Marco Rubio, and let's add a few more names to that mix, Mike Waltz, the incoming national security advisor to Donald Trump, also voted in favor of the TikTok ban and is a noted China hawk himself. And then there is the incoming head of the FCC, Brendan Carr, who also railed against the app and the national security risks it posed. Remember, this is what is driving this divest or ban law and the call for the Chinese-owned company ByteDance to sell the app. The U.S. policymakers here in Washington are concerned that national security could be compromised, that the app could be used to gather intelligence and data on U.S. citizens, including people in sensitive roles within the government, and also be used to gather, or rather to disseminate propaganda that is unfavorable to the U.S. and U.S. interests. So we will see pushback within the administration and in Congress. But then again, we have seen so many of Donald Trump's loyal supporters, his allies, and the people who work for him fall into line if that is what he wants.
Well, let's cut through the noise. He says that this is because he won the youth vote. He didn't, but he did make significant inroads with youth voters. He's also talked about the fact that, you know, if you don't have TikTok, then there's Mark Zuckerberg and wants to make sure there's competition in the tech space. And then there's a Trump donor by the name of Jeff Yass. What is driving Trump to this warm, fuzzy feeling of TikTok?
There may be one other thing, and I think those are all factors, Anne-Marie, and you brought up a couple of key points there. Another is simply that TikTok also just appeals to Trump in a way, to his instincts as a showman, as an entertainer, and he also likes engaging in this kind of corporate diplomacy. We also see other high-profile tech CEOs making a pilgrimage, if you will, to Mar-a-Lago to meet with the president-elect to try to get their voices heard, to get their business issues presented to the president-elect before he takes office, so he knows what is at stake for them. Jeff Bezos is set to head there tomorrow to talk about a range of issues. Some of them may include antitrust concerns and whether the strict enforcement being pursued under the Biden administration will continue under Donald Trump. We also saw the Google CEO Sundar Pichai and one of the co-founders, Sergey Brin, visit Trump at Mar-a-Lago, and Mark Zuckerberg himself also had dinner with Trump and Tim Cook. But Xiao Chu of TikTok has probably the most at stake and most immediately. So these are all the different push and pulls there. It's the corporate diplomacy, it's the campaign interests, Trump's instincts as a showman and entertainer. And yes, he does see it as a way of appealing to younger voters, even if he didn't actually win them through TikTok.
When you put this together, Shep, corporate diplomacy, as well as some of the national interests and the national security threats that some people have raised about the likes of TikTok, has there been any cohesive message coming out of the future administration about what investments from foreign companies would look like coming into the U.S., whether they would be welcomed or whether they would be shunned?
Well, we did get a signal of that in pretty stark terms yesterday with Masayoshi Son of SoftBank Group coming to Mar-a-Lago to announce a $100 billion investment plan in the U.S. He didn't offer too many specifics, but people familiar with the matter did tell Bloomberg that it would be in the area of artificial intelligence, semiconductors, and other high tech. We don't know where the money will go or to what startups, but it was warmly embraced by Trump, who literally embraced Masayoshi Son on the stage at Mar-a-Lago yesterday and handed the microphone over to Son, who talked about what he sees as great confidence in the incoming administration. And that was a confidence that Trump sensed and then even went further and dared Son to try to double the investment he had just tried to announce at $100 billion. So this is the sort of reception that we'll see. Now, one thing Donald Trump has tried to get foreign companies to do is not only invest here and move some operations here, he wants them to make their headquarters here. And that may be a bridge too far. We don't see SoftBank moving its operations here. This is really money coming into the U.S. for projects here.
Shep, forgive me, but I'm trying to put this together with Nippon Steel. Here we have someone who is over in Japan investing a significant amount of money into artificial intelligence in a number of sectors that are considered pretty sensitive for national security, at the same time that Nippon Steel is completely an unfavorable deal. We've heard that from the current administration. We've heard that from the future administration. Is that relevant, or is there enough sort of apples to oranges that I'm conflating two issues?
I don't think you're conflating two issues, because there is some dissonance that you're picking up. Wait a minute, why is one foreign investment good and this one, maybe by Nippon Steel, bad? Now, the big difference really is in more the symbolism. There is a strong union interest, obviously, in U.S. Steel. And then there is also just the iconic quality of the company itself. The name U.S. Steel, the location in Pittsburgh, Pennsylvania being a critical state in any presidential election, the one we just had and the one we're going to have 4 years from now and even 8 years from now. So there is a stronger political component to the U.S. Steel question and Nippon Steel's attempts to buy it than you see with something like SoftBank or other foreign companies trying to invest here. And it is also taking control, and that is a different thing. If SoftBank were to try to acquire a name brand U.S. company and make it Japanese flagged and owned, that would be a different story, perhaps. And that would also kick in the same process that is scrutinizing the U.S. steel acquisition, and that is the CFIUS process we've talked about before.
Hey, Shep, appreciate your time, sir. Thank you. Mike Shepard down in Washington, D.C. Successive governments down in Washington, D.C. just completely undermining the CFIUS process. We've totally blurred the lines between what is and what isn't a national security risk. The fact we're even having this conversation around TikTok, I find absolutely ridiculous. If it's a national security risk, there is no other conversation. From New York, this is Bloomberg. So it is December 17th, and just check out the performance so far. Nasdaq futures right now slightly positive on the session. We're slightly negative on the Russell. Check out the month. The Russell is down about 3%. The Nasdaq 100 is up more than 5%. We're talking about 8 percentage points of outperformance for the Nasdaq 100 halfway through the month of December.
This basically is the complete reversal of what everybody thought would be the Trump trade, where suddenly the small caps would outperform, and you saw this rush to the undervalued names that was supposed to lead for the next year. Question is this a blip, or is this really telling of what's to come? AI tends to be the safe haven. So at a time of great uncertainty with respect to policy and rates, it continues to be those large tech names that drive performance.
We talked about that headline that came out of Barron's over the weekend, Embrace the Bubble. Bank of America. Bubbles can last longer than you can stay underweight. That's their message going into 2025.
Which is the reason why they're cautious, and yet they recognize the fact that everybody is completely bullish. They do talk about a contrarian signal. At the same time, they talk about how investors are the most underweight European stocks since October 2022, even as they are the most bullish or increasing their allocations to U.S. stocks the most in September 2023. At what point is the bar so low? Do you go into Europe? Katrina, Dudley? Not yet.
Talk more about Europe in just a moment. That's the Nasdaq and the Russell. The S&P, by the way, is down by about 0.2%. In the bond market, 2-year, 10-year, 30-year yields a little bit higher, up by 2 basis points, 442.25. On a 2-year, up by 3, 427.63. Retail sales later on this morning, Lisa. The last big data point going into the Fed's meeting tomorrow.
Yeah, it's going to be a frustrating number to interpret. I'm just going to lay that out right now, because it's going to be the rebound effect from the hurricane that's going to really drive a lot of noisiness. At what point can people get some confidence from these retail sales? Under the hood, I'm going to look at what people are buying. If it isn't necessarily just that they're buying a lot of eggs that are much more expensive, that will be a good thing. It will suggest that maybe it is broad-based, and it really speaks to the composite PMIs that we got yesterday that really outperformed the U.S.
The data was good. S&P Global Services, big upside surprise there going into the Fed meeting that starts today and concludes tomorrow. In the FX market, dollar strength, dollar strength, dollar strength. Through the quarter so far, only one down week for the US dollar in Q4. At the moment, we're down to about 105, 104.91, and euro dollar down by 0.2%. More bad news for Europe. Where do you want to begin? Where do you want to end? German business confidence just not great.
Honestly, there's a really difficult reason to push against the consensus, and it has to do with where else are you going to go? Are you going to go to Europe, where basically you can't see governments stay together for longer than a few minutes or a few days? Are you going to go to Japan, where they're talking about not necessarily hiking rates, and suddenly you have this really renewed low, a renewed weakness in yen? What is the alternative? And that is why we keep watching gold. Is that the barometer? But even that hasn't necessarily performed. So at a certain point, either embrace the bubble or go home. That has been what performance has done.
I'll tell you what it's not. The alternative is not the Canadian dollar. And we'll talk about Canada a little bit later. Give Canada such a hard time on this program, don't we? Don't mean to.
Hold on a second. Let's not throw us all under the bus.
Hey, we're a team, aren't we?
Some of us are defenders.
I get called bearish all the time because of you.
Okay, fine. You could be bearish, but Canadians are nice.
We thrive together.
We do.
We survive together. We drown together. We're a team, Brahma. Under surveillance this morning. Bank of America's latest global fund manager survey finding sentiment is super bullish, showing cash allocation at a record low with US stock exposure at all-time highs. Strategists pointed to Trump's election victory, US growth optimism, and a Fed that's cutting interest rates. That's the opposite of a toxic brew into next year.
Yeah, what is this? The Goldilocks soft landing, the Nirvana
stirred into a pot.
Well, let's come up with something beautiful. There is this feeling that a lot of good news is priced in, but there still is hesitance. You talk about how people are out there looking for reasons to be bearish, and one of the biggest ones is potentially a disorderly rise in bond yields. That's the T. Rowe Price point about potentially getting to 6%. But even that, people are pushing against. You have basically the likes of the biggest bull on the street, John Stolfus, saying It doesn't have to be perfect. It doesn't have to be roses. Yields can be higher, but AI is going to solve everything.
This reminds me of the Chris Harvey note last week when he said shy bulls, really? And they're only potentially shy because they just want to be contrarian. It's not driven by fundamentals. They're just concerned that everyone is on one side of the boat, and potentially that makes them a little bit nervous.
Well, they're not in China, and there's some nerves around that, that's for sure. Reuters reporting that China plans to set an annual growth goal of about 5% for next year. Officials are also said to be planning to raise the budget deficit to 4% of GDP. Both of those targets are largely in line with economists' expectations after policymakers pledged to boost government spending. That's the latest out of China. Here's the latest out of Canada. Pressure building on Canadian Prime Minister Justin Trudeau. Calls for his resignation growing from his own members from his own party after Finance Minister Chrystia Freeland stepped down. Her resignation coming just hours before she was expected to unveil an economic update.
You were right, Jonathan, to bring up the G7 photo op. A bunch of lame ducks around Georgia Maloney. And that's what we are seeing. This time, it's Canada. It was in Germany. It was in France, where Macron is just barely holding on to power. And now it's Justin Trudeau, members of his own party. This is what's stunning. It's not the opposition. It's his own party that's saying, now might be the time to go, because the finance minister stepped down, and in such a scathing way. Basically, she admitted that she was basically demoted or fired because they disagreed on how to deal with just their own economy, but also what's going to happen with Trump coming into power.
Liberal virtue signalling is taking an absolute beating over the last month. I think we have to point this out. Only a week ago, the Canadian Prime Minister, Justin Trudeau, comes out and says, "You have an ally in me. I'm a feminist," and talks down to American voters for electing Donald Trump and not electing Kamala Harris. And then days later, puts the pressure on his own female finance minister. I mean, come on.
First female finance minister. And this morning you have the Globe and Mail, for those Canadian viewers, saying Freeland's latest woman to exit the cabinet as other question Trudeau's feminist credentials. He has been in power for 9 years. Maybe he'll be stepping aside for Mrs. Freeland.
You can say whatever you want, but ultimately it comes down to debt. And I think that that's the bottom line. And I think that everyone can coalesce around that. And you can signal whatever you want. But if the deficit and the numbers don't add up, everything else doesn't make sense.
She did not want to be the face of that.
Correct.
That's for sure. And that resignation coming hours before that economic and fiscal update. We'll have more on this story from the economic and foreign exchange perspective a little bit later this hour. Let's turn to Europe. German lawmakers clearing a path for an early election in February, backing Chancellor Olaf Scholz's plan to end his embattled administration. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome back, sir. It was something he triggered, something he hoped for. What's next now for the people of Germany?
So listen, this was the expectation, but it's still significant. This is really only the second snap election we've ever had in Germany since the fall of the Berlin Wall. The last one was in 2005, and that is actually the election that ushered in the Merkel era, which has paved the path for many of the things that we see before us today. What we are getting today, after yesterday, where there was a very fiery debate, right? We had Olaf Scholz really trashing the FDP, his former finance ministry, saying that they're basically morally unfit to govern. We had Friedrich Merz of the CDU, the center-right, calling Olaf Scholz a failed chancellor. And then hearing more and more from the AfD, the far right. They now hold 20% of the vote here in Germany. They're an unignorable political force in Germany, saying that Germany is basically on the brink of collapse and that a vote for the CDU and Friedrich Merz is a vote for war with Russia. What we're getting today from the CDU is their official party platform. It's the official kickoff of this election. I know it feels we've been in it for a little while. We got it from the CDU. Now we're getting nothing too spectacularly new. Basically, the recipe is lower taxes, cut bureaucracy. You talk to people in Germany, no one can name the last time bureaucracy was actually cut in the government and cut social benefits. They think they can find 100 billion euros in a cut to social benefits. And we're going to get the same from Olaf Scholz a little bit later at 8 a.m. Eastern Time, 2 p.m. local time, getting his party platform. That's going to be a lot heavier on the sort of spending. But at the end of the day, guys, the reality of the situation is there is going to have to be another coalition after this. And there is a fear in Germany that you're going to be basically just trading one dysfunction for another.
Ollie Crook with the latest out of Berlin. Ollie, appreciate it, sir. Thank you. Anne-Marie, we talked about this a few times. 2 months ago, the big fear of Wall Street going into the US election was dysfunction in American politics, not having a clear winner, working out how this could play out over the next 2 months, that maybe we'd be sitting here in January of 2025 still not knowing who would be the future president of the United States. And the truth has been the stability is in American politics. The instability is almost everywhere else.
So my sources outside of Washington were always saying to me whether or not they were in the Gulf or in Europe about how conflict was brewing in America. But it's actually the opposite. There's two hot wars, and there's political instability stretching from South Korea to Germany to France to now Canada.
Let's focus on Europe now. We can turn to Claudia Buch, the ECB Supervisory Board Chair, joining us now following the bank's annual supervision press conference. Claudia, welcome to the programme. We appreciate your time. A difficult moment for Europe, for political leaders, for policymakers. How are you preparing for the upcoming Trump administration, and what are you suggesting to policymakers they need to do right now?
Well, thank you very much for having me. It's actually not for me to advise policy makers what to do. So what we do here in the ECB is that we published today the results of our supervisory review and evaluation process, which is our core health check, if you want, for the European banks. And one result is, and I think this is important in these uncertain times, one important result is that actually the European banking sector is robust. So we see good levels of capitalization, good profitability, and also good asset quality. And I think this is important because we are in a period of heightened uncertainty, geopolitical risks, and it's important that we have a sound and stable banking system.
Claudia, one thing that's fascinating to us is how much has changed in terms of the economic and structural paradigm. We were talking about how different things are than, say, 10 years ago, where banks were considered too big to fail, and that was the big risk. Now, how much is the bigger risk that too many banks, particularly in Europe, are too small to succeed?
Well, it's interesting that you mentioned how much has happened, because actually a lot has happened in Europe and with regard to supervision. So we have the banking union now. So for 10 years now, and we celebrated the 10th anniversary this year, we have common supervision within the ECB, and of course with an important role also of the national competent authorities, but the ECB is taking the decision on supervision. We are applying the same standards across all banks. We supervise directly the significant institutions, and we also have an oversight function over the less significant institutions. And I think this is great progress. We see it in the data. We see that there's better capitalization, better asset quality, and this is certainly, amongst other things, a success of the banking union and of the single supervisory mechanism. But of course, we need to remain vigilant, because there's, in addition to geopolitical risk, there's also structural changes happening in the real economy. So we watch very carefully how, and if so, in which form this would affect banks' balance sheets. So far, we are not seeing an increase in non-performing loans, although we're seeing an increase in corporate insolvencies across Europe, and this is something we are monitoring very carefully.
Claudia, in the United States, the concern is not about insolvency. It's not about risk to loans. It's not about weakness in terms of what the assets are on bank balance sheets. It's, can they grow enough? Let's go. Can we do mergers and acquisitions? Let's get that banking sheet back up. In the European region, one of the biggest threats to a lot of these banks is not the threat of weak loans right now, but a lack of loans and a lack of income and a lack of profitability that can really drive that strength to compete with U.S. banks. How much is that an increasing concern of regulators that have been tasked for the past 10 years with preventing weakness in loans?
Mm-hmm. Well, I mean, this is an interesting question, because I sometimes hear that what we do in terms of supervision regulation in Europe is too conservative and would prevent the banks from lending to the real economy. I mean, this is actually not what we're seeing. So generally, we've seen that with the reforms that have been implemented post the global financial crisis, the banks have become stronger, more capitalized, and actually they're in a better position to lend to the real economy. What is true is that loan growth has been moderating in Europe, but this is also to a large extent driven, of course, by higher interest rates, by the demand side, but it is not due to supply side constraints. As I said before, the banks are well capitalized and they have sufficient management buffers also on top of the supervisory prudential capital requirements.
Do you expect then any recent activities you're seeing, and you're saying there's health in this banking sector, but do you think we're going to see more deals next year?
Well, hard to say, hard to forecast. I'm not sure whether anybody has those numbers or those forecasts. I mean, let me say what I think is happening when it comes to consolidation in the financial sector. I think it's a quite natural response of banks to a changing competitive environment. And of course, the digitalization of financial services is a very important driver here. So I think it's really up for the management, the shareholders of the banks to decide how they want to respond to this, to the changes in the competitive environment. And one way can be mergers, domestic mergers, cross-border mergers. And we have a very clearly defined role according to the legislation in the approval process. So we look at the prudential ratios, we look at the soundness of the stakeholders involved. So this is our role here. But again, it's not for us to decide, to take the decisions that in the end the management and the shareholders of the banks have to take.
Claudia, just a final question from myself. I'm just wondering how you view the current recent instability in places like France and Germany, and whether you're confident there is some distance between the performance of sovereign debt and bank equity, because we saw that correlation really spike 10 plus years ago in the Eurozone debt crisis. We've seen at times this year the European sovereign debt has been treated like it is credit, particularly in places like France. Outside of the Eurozone system, we saw that in the UK a few years back. How much confidence do you have around that issue this time around?
Well, I mean, what certainly gives me confidence is that the good capitalization of the European banks. And as I've said before, a lot has happened in Europe in the past 10 years. So it's not only that we have common supervision, but we also have a new resolution framework in place. We have more loss bearing capacity on banks' balance sheets. And so I think these are all very important factors that also weaken the bank sovereign nexus that we have spoken about 10 years ago. This was actually one of the reasons to have the banking union to break the bank sovereign nexus. And a lot has happened. So we clearly pay very close attention to geopolitical risks, to future uncertainty. So I'm not saying that these are not there, but the good level of capitalization and all that has been done to weaken the bank sovereign nexus should give us also comfort.
So lots to think about for 2025 for the continent and beyond. Claudia, appreciate your time. Thank you. Claudia Buch there, the ECB Supervisory Board Chair. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Biden administration has been trying to ease concerns about the thousands of drone sightings that have been reported in New Jersey and other parts of the Northeast. White House spokesman John Kirby told reporters that the drones are, quote, a combination of personal, professional, and government aircrafts. President-elect Donald Trump says he thinks that the White House knows more than it's saying. Trump added he doesn't think it's an enemy, but suggested his New Jersey golf course could be a target, saying that they are flying very close to Bedminster. Alibaba shares are falling in the Hong Kong trade, down 2%. It agreed to sell its in-time department store business to Younger Fashion for around $1 billion, offloading a non-core asset. The sale will result in a loss of $1.3 billion on Alibaba's initial investment. The e-commerce giant is struggling to grow with competition from rivals like PDD and ByteDance. And T. Rowe Price out with a punchy new call on Treasury yields, saying the 10-year may climb to 6% for the first time in more than 2 decades. Arif Hussain, the firm's fixed income CIO, pointed to inflationary policies and a growing deficit under Trump. Hussain wrote that he expects yields to reach 5% in the first quarter of 2025. That's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, Trudeau on the brink.
We're now less than 2 hours away from the fall economic update. Why won't the Prime Minister have the courage to come in here, present it himself, and put it for a confidence vote tonight?
That conversation up next. Equity futures on the S&P down by about 1/3%. Under surveillance this morning, Trudeau on the brink.
Mr. Speaker, just to underline the chaos we're faced with here, the finance minister resigned the day she was to present the fall budget, which was going to contain a massive deficit overrun. We're now less than 2 hours away from the fall economic update. Why won't the Prime Minister have the courage to come in here, present it himself, and put it for a confidence vote tonight?
So here's the latest. Pressure building on Canada's Prime Minister as President-elect Donald Trump's threat of tariffs divides Trudeau's government. The Finance Minister, Chrystia Freeland, resigning just hours before she was due to unveil an economic update, writing, quote, "Our country faces a grave challenge. That means keeping our fiscal powder dry today, so we have the reserves we may need for a coming tariff war." Her parting shots pushing Trudeau's government as close as it's ever been to collapse. Mark McCormick of TD Securities joins us right now for more. Mark, you're there. You're following it closer than we are. What's next?
Well, I think what's very clear, this is a common theme. This isn't just Canada. This is happening in France. It's happening in Germany. It's happening all over the world. What you're seeing is that the election of Trump is a disruption to the existing order. And I think a piece of this is work together in the markets and work together in the economy. What we're seeing is central banks are trying to cut rates to stimulate the economy. Fiscal policy is being used to stimulate the economy. Voters are unsatisfied with incumbents. Incumbents are trying to find ways to maintain power. And that's just when you think about where this is going, where you think the existing order is going, it's just very clear that, using like short-term incentives just to spend money to kind of help people ahead of an election is really not a long-term strategy for economic policy, especially when you think about innovation and investment. And again, this is a common theme that you saw in the UK budget. So I think this is not a piece of like what's going on in Canada. This is clearly not idiosyncratic. But what's very clear is that the political economy, what we're calling geo-macro, is a force that's creating disruption. It's creating more volatility, more uncertainty, and it's coming through the currencies first.
Mark, and how much does this really push people back toward the dollar? Because there isn't another alternative that necessarily is more put together, whether it comes to the government or whether it comes to the economy.
Yeah, it just reinforces dollar exceptionalism, U.S. exceptionalism. These are things we've been talking about for months. I think one of the things that's very clear is we run a quantitative macro framework. We looked at different styles and drivers of markets. The dollar has behind it as a tailwind the equity market. It's got carry. It's got momentum. It's got essentially the terms of trade. It also has growth. So you can't think of a better mix. The one thing that's a little bit challenging right now is markets have been really focused on mean reversion. So positioning, short-term valuation models, those things have worked to predict currencies all year. But what we're starting to see is momentum is a factor that's becoming increasingly more important as we push into the new year. So I'm a little bit wary here of like people coming in and buying the dollar with a couple weeks left in the year. But it's very clear where we're going in the front half of next year, and it's going to be a strong dollar across the board.
But what about the end of 2025 going to 2026? A lot of analysts are talking about the fact that actually we could see some weakness or at minimum a plateau of the U.S. dollar.
Yeah, this is an important theme. I think because what we're seeing is a disruption to the global trade order. Again, you can look at we have indicators we looked at for globalization. So if you look at globalization as a theme, hyper globalization, economic and trade peaked 10 years ago. It's been moving sideways. But along with the correlation, the thing that you see is that as globalization was rising, hyper-globalization was rising, the U.S. trade deficit was rising, and the U.S. dollar was getting very expensive. So if you think about what is the North Star of the Trump administration, one thing he's talked about, and one thing that I think is very important to their economic policy, is eliminating the trade deficit. You cannot reindustrialize the Rust Belt. You cannot reindustrialize the states that won it for this, for Trump, in this last election, Michigan, Ohio, Pennsylvania, Wisconsin. Those states, what matters, I think, is the reindustrialization and also the reduction of the trade deficit, which means you need to find a way to weaken the dollar. So I think what's going to be very important as the world's breaking apart and as the global order is being ripped apart, again, most countries are choosing national sovereignty over globalization. This is not a U.S. story. This has been going on for over a decade. And essentially, as that order gets picked apart, the dollar rallies. It's the only game in town. It's FOMO. It's all these kind of themes. But that creates the conditions for the Trump administration to address the major concern for industrialization, which is the trade deficit and the strength of the dollar, which, again, if we look at our longer term valuation models, the cheapest currencies in the world are the yen, the renminbi, the yuan, Taiwanese dollar, all the Asian currencies that were low yielding funding currencies.
Elisa said it already this morning. What's the alternative? Mark McCormick at TD. Mark, thank you. Kit Jukes of SocGen questioning how much oxygen is left up here. We're driving the price of an asset up to something that is not sustainable over the longer term, but here we are.
Yeah, exactly, because of the point that Mark was making. At a certain point, it runs counter to some of the tenets of the new administration. Just not yet.
Up next on the programme, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management, John Lieber of Eurasia Group, Sharon Miller of Bank of America, and Dan Ives of Wedbush. From New York, the second hour of Bloomberg Surveillance. Up next.
There's this undercurrent of instability within the overall stable labor market. I don't think it stays stable in 2025.
The unemployment rate is actually creeping back higher to where it was over the summer. That's the reason that the Fed is really focused on maintaining this easing bias.
I think the FOMC will go ahead now and cut by 25 basis points.
We are looking for a Fed that remains very sensitive in terms of the economy.
We are trying to maintain this soft landing, and the Fed has done an incredible job so far of doing that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The Federal Reserve decision, I think 31 hours away. We're counting down eagerly. Won't be sleeping. Equity futures on the S&P 500 down by 0.25% on the S&P. Before we get there, we've got retail sales in America in about 90 minutes' time. 2 p.m. tomorrow afternoon, we'll hear from the Federal Reserve, their decision and their outlook, new forecast, the update to the previous forecast, and a news conference with Chairman Powell 30 minutes after that.
Key question will be how he messages 2025 and really whether we get a sign of what kind of dissent there was under the hood. Remember, there was this huge battle on the Fed about 50 basis points. It seemed like Jay Powell jawboned them into that 50 basis point initial cut with that expectation that things would weaken. Now, how does he message a concern that maybe things aren't really that weak and that maybe there is the fear of reacceleration?
And you have that with Neil Dutta coming out and talking about concern is actually going up. Labor markets have been cooling. Home building stocks are presently underperforming despite rate cuts. I see myself on the more cautious side of the consensus at present. 2025 is going to be very difficult for the Fed. And what we just heard from Mr. McCormick up in Canada, this idea that it's actually geo-macro events driving financial markets.
The dollar's still strong. Why? To that point, France is a mess. Germany's a mess. Canada's a mess. South Korea's a mess. The Middle East's a mess. China's a mess. The list goes on and on.
Which is the reason why maybe the vigilantes have kind of taken a breather, except for T. Rowe Price, who seems to be still on the vigilante bandwagon. But it raises this question of, can the U.S. continue its fiscally reckless policies because everybody else is even more fiscally reckless and doesn't even have a government to boot? So at a certain point, does that give people confidence about the U.S. or just, go into Bitcoin, which maybe is why Bitcoin's been rallying?
What do we say on this program? The unique privilege of acting recklessly. That's what the United States have.
That's what we say on this program.
We. Slash
We're really
me.
going to do this. I know. All right.
We're in it together, Bramwell. How many times do I have to say this?
Absolutely. The unique privilege of acting recklessly like I feel like I do every morning.
Every single morning. Coming up this hour, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management as the Nasdaq hits a fresh record high. Sharon Miller of Bank of America on the state of small business in America. And Dan Ives of Wedbush as Tesla hits another all-time high. We begin this hour with stocks mostly flat. The Nasdaq coming off another record as investors await a highly anticipated Fed rate cut. Dan Greenhaus of Solus seeing plenty of opportunity next year. It's been a tremendous year for both equity and credit, which understandably leaves many investors fearful of sounding too optimistic entering 2025. We feel differently. The economy is doing fine. Inflation is largely normalized and the consumer remains strong. Dan joins us now for more. Dan, it's good to see you.
Good to see you, sir.
Would you say the street is uncomfortably bullish then going into next year? Because overwhelmingly it feels like people are bullish because they feel like, what's the alternative? What else can they be? Is there some career risk associated with being slightly bearish in 2025?
I think uncomfortably bullish is the right way to put it, at least my interpretation from talking to people around the street and watching Bloomberg TV at 7 a.m. as I do every morning. After 2 years where the S&P is up 20%, high yield and loans and even the lower rated credits are up 10% or so this year. And there's a feeling, well, this can't continue. And so there's a hesitancy to sort of embrace this. But in reality, I think, and you guys talk to people obviously for hours a day, every day, I think there's been whether you're listening or not, Lisa, is a separate story. But
thanks for really beginning on a great note. Carry on.
There's been a hesitancy to embrace the bullish tone of things for several quarters now. So in that sense, I don't think it's anything new.
Is there a difference between what people are saying and what they're doing? The Fund Manager survey out from Bank of America says things are tremendously bullish at the moment. Cash allocation record low, US equity allocation record high. Do you sense things are that frothy? Sentiment is that high?
Yeah, I got asked the other day whether I thought this was euphoria. And no, I don't think it's euphoria. Clearly, the Bank of America data that you just referenced plays into positioning data, which suggests that people are certainly invested and depending on how you measure positioning, at the upper end of the range that's prevailed, let's say, since the GFC. So people are certainly in the market and expecting it to continue. Do I think it's euphoria? Listen, I don't. what I guess the subsequent question thereafter becomes, well, what separates what we're experiencing now from euphoria? And I guess thinking out loud here, there's still an acknowledgement. You mentioned the geopolitical risks on the way into this conversation. There's still an acknowledgement that things are not great. Incoming President-elect Trump's policies could be inflationary. You could have a widening of the wars, et cetera, et cetera. So I think euphoria is probably an environment in which all of that stuff is not even acknowledged. And I don't think that's where we are now.
Vulnerable is another way to put it. That at a certain point it is a market that becomes increasingly vulnerable to a potential shock when everyone is in one trade and they feel like they've been pushed into that one trade because there is no alternative. Do you feel that vulnerability in some of these crowded trades where, one thing could go wrong that's unforeseen and it could really torpedo a real mass trade that could lead to an exodus?
Listen, and I don't think this is a particular secret, or I'm certainly not breaking any headlines here, but if something happens on the AI demand side of things, my argument for a year has been when people talk about this, everyone's in the trade or we're susceptible or vulnerable to it, we have seen no evidence from virtually any of the companies involved in this technology development that demand is weakening at all. And when you look back to the and we talked about this the last few times I've been on, when you look to the 90s, Floyd Norris in the New York Times talked about the stock market being in a bubble in 1995. Greenspan's irrational exuberant speech was 1996. And obviously we still went on and had 97, 98, and certainly 99. It wasn't until 2000 when you started to see those demand trends weakening. It's not like we didn't know along the way that we were overbuilding. There was the story about the telecom cables could wrap around the earth 1,000 times or whatever it was. We knew we were overbuilding, but it still took until those demand trends weakened for the broader environment to really, to borrow the word I just used, weaken. And I think now, whether it's AI or Broadcom the last 2 days, or any of the derivative trades, I haven't heard, and again, I've said this 100 times, Solus is not a particularly large tech investor, and we don't own any of these names, but I haven't seen any suggestion from anybody, either on the sell side or from the companies themselves, that demand trends are weakening. All I keep hearing is demand exceeds supply from just about anybody who has any comment.
One thing that Solus does have a pretty big footprint in is looking at the potential combinations of companies, particularly in media space, particularly in a couple of other industries. And this has been an area that a lot of people think is going to be really hot next year. How much are you seeing that in sort of the ground up analysis of companies in different sectors? And which sectors do you see the most active discussions?
Well, listen, we had the Lamb Weston headlines the other day. I think I'm certainly in the camp that thinks next year is going to see a pickup in M&A activity. You see this, the issuance trends are emblematic of this, and just CEO body language is emblematic of this. So I'd expect to see that. One area, you mentioned Solus's involvement in the media space. I would point, for instance, to what's going on with Comcast and Warner Brothers spinning out the linear, or to oversimplify it, spinning out the linear networks. The assumption is they're going to combine, and there's a lot to do there from our standpoint. I think when people think about high yield and credit investing, a lot of that conversation becomes about Dish or Altice. But those are the types of things that we pay a lot of attention to. Solus has a 20-year track record of investing in the media space. And I think there's going to be a lot there to do in that space, for sure.
Are you expecting, then, a light regulatory touch?
So I think the conversation is, well, Lena Khan's gone, so it's game on. And I don't think that's the case. And I think you and I have talked about this in the past. I think when you really, and I'm sure you're well aware of this, when you really dig into J.D. Vance's philosophy and the people around him, it's not a game on type philosophy. There's still going to be a scrutiny of the big tech stocks in particular, of the tech companies in particular. But I also don't think, listen, Josh Hawley, J.D. Vance, Tom Cotton are not going to green light any merger, so to speak, either in the public domain or actually from the FTC standpoint. I think there's still going to be a lot of scrutiny here, but will it be lighter than what we've experienced the last couple of years? I think that's unquestionably a yes.
You were with us on election night. Do you think that this idea of the Trump trade is just overrun, though?
No. Listen, I think, I guess maybe yes. Half no, half yes.
What's the no and what's the yes?
So the no is, listen, we're going to have a friendlier business climate, the CEO confidence. Bloomberg has a story this morning about CEO confidence spiking up. You saw it in the small business survey. Small businessmen are apparently all Republicans because that number spiked up to the highest level.
There's political bias in some of these surveys.
There's certainly political bias in some of these surveys. And by some of these surveys, we mean all of these surveys. But so in that sense, no, this is going to be 2 years at least until the midterms, probably 4 years of a more right-leaning, business-friendly climate, and so that's going to persist. At the same time, I think there's, and I'd be curious of your thought on this, there's a lot of enthusiasm and optimism about what this administration can accomplish, and I'm a little more skeptical. I think obviously the TCJA is going to get extended, but can you also afford no tax on tips? Can you also afford a further lowering of the corporate tax rate? I'm a little skeptical that this Congress is going to pass that.
So you're skeptical of the good stuff that would be beneficial to the market and the business climate, but what about tariffs and things that can actually have a negative impact?
Yeah, I enjoy this conversation a lot. I think that the talk around tariffs is just so universally bearish and bad. And listen, I don't want to give away my free market bona fides here. Like, certainly tariffs are not optimal, but I also look back in the period in which we had tariffs, and I don't remember them being dystopian in any meaningful way. I mean, obviously, everyone likes to point to the headline index. There was no meaningful jump in inflation. But when you dig into the core goods data, there was a reversal of the multi-year downward trend. So core goods prices certainly did respond. But if we can simultaneously get the currency to move, if we can simultaneously get oil prices lower, maybe incoming President Trump is a little friendlier with the Saudis, and we can maybe get 1 million barrels back on the market, and we can get oil down into the 50s. That'll help compensate. And so
How are you going to do that when U.S. companies are actually pulling back, like Chevron at the Permian? There needs to be a higher price to actually incentivize American companies to want to continue drilling.
Well, listen, I mean, we're pumping 13.5 million barrels right now, essentially a record high. So output in the United States is not the issue. Obviously, you've got the voluntary curtailments across OPEC, several million barrels, spare capacities in the several million barrels. Obviously, they keep trying to bring that back on, but we're worried about Chinese demand. And so there's a lot of moving parts here. But I also think geopolitically, if you're President Trump, your goal is going to be to lower prices. And what is the easiest way to do that? It's going to be much harder to spur additional production in the Permian than it would be to just somehow get the Saudis to agree to pump a little bit more oil, which they might not. If you can compensate that by lowering Iranian output, then
or Russian. Yeah.
Or Russian. Iranian is probably easier because the Iranians are back up over 3 million barrels right now. That is up a lot from the day President Trump left office. If I'm President Trump, optimally, you get 1 million Iranian barrels off the market. You compensate that with a million Saudi barrels. Maybe you depress oil prices a little bit in that environment. Win, 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 win.
They clearly want to run this hard. Just a final question to you.
We just started. How is it final already?
You're about 12 minutes into the segment. High growth, low inflation, disciplined on fiscal. Out of those three, which one do you think will be more difficult for the incoming administration to achieve?
High growth,
low inflation, disciplined on fiscal.
Fiscal. There's no one in Washington. This is a parlor game that we've played for decades now. There's no one's cutting spending. Spending never gets cut.
Is Elon watching?
I hope he's. Listen, I'm happy. I mentioned last time, I'll go work for Doge. Not full time, but I'll go work for Doge. This is not brain surgery. The CBO puts out a report all the time, all the different ways you can fix the deficit. Former Senator Tom Coburn, now Rand Paul, puts out I forget, the waste book it's called. All different ways that you can cut. This is not brain surgery. There's the famous movie, not famous, there was the movie Dave, where the fake president comes in and he brings in, I forget who it was, Charles Grodin. And Charles Grodin's his friend, he's an accountant, and he sits down and he looks at the government books and he goes, this is the worst looking thing I've ever seen. If you put 5 Republican economists or government fiscal people in a room with 5 Democrats, they can solve the problem over lunch. The problem is no one knows how to get elected once they fix the problem.
It's true.
Which is why nothing's getting done.
It's good to see you. It's why yields are still north of 4% on a 10-year.
Thank you for having me back on in the 7 hour, not at 6:30.
OK, we're going to keep that going. Don't worry. Okay. You want the 7-8? The 7-8. All right.
Whatever,
make that happen.
Wherever you have me, I'm thrilled to come in. Right. Thank you.
OK. Dan Greenhaus of Solus Alternative Asset Management. Have a very happy Christmas, sir.
And you as well.
And Merry Christmas,
guys.
Thank you. Thank you. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump lost a bid to have his hush money case tossed. A New York State court judge found that the July Supreme Court decision granting broad immunity didn't affect Trump's state conviction. Trump's team had argued that the trial was tainted by testimony and other evidence that shouldn't have been allowed under that decision. It's unclear if the case will proceed to sentencing, with Trump continuing to challenge the verdict. Morgan Stanley looking to profit off the surge in SpaceX. People familiar said the bank is opening its specialized lending program to SpaceX employees who want to cash in on soaring shares but not lose their equity stake. In order to participate, employees need at least $500,000 of vested SpaceX stock. The loan structure includes an advance rate of 15% on the value of pledged shares with a loan maintenance of 40%. 7 of the world's 10 busiest airline routes are to the Asia-Pacific region, a comeback for Asia travel. Aviation data provider OAG said the busiest international route of 2024 was from Hong Kong to Taipei, second place Cairo to Jeddah, and in third place Seoul to Tokyo Narita. Rounding out the list at number 10, New York JFK to London Heathrow, the only transatlantic trip to rank in the top. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, spiralling tensions between Moscow and Kyiv.
Got to be a deal. No, got to be a deal. Too many people being killed. That is a war that's on. Too many people. Got to make a deal. And Putin has to make a deal.
What does that deal look like? That conversation up next, live from New York City this morning. Good morning. Equity futures on the S&P down by about 1/3%. Another close at a record on the Nasdaq 100. Nasdaq 100 futures this morning pulling back just a little bit. We're down by 0.2%. Bond yields are higher by 3 basis points. The 10-year at 4.43. Under surveillance this morning, spiralling tensions between Moscow and Kyiv.
Got to be a deal. No, got to be a deal. Too many people being killed. That is a war that's on. Too many people. Got to make a deal. And Putin has to make a deal. Putin has to make a deal. And Putin would have never gotten it if I was president. If I was president, we wouldn't have had inflation. Our oil prices would have been lower. I had a good relationship with Putin, despite the Russia hoax.
So here's the latest this morning. Ukraine is claiming responsibility for assassinating a Russian general in a Moscow explosion earlier on today. Joining us now is John Lieber of Eurasia Group. John, how do they close any kind of deal with things like this happening?
Yeah, it's a great question. I mean, I think that we know Trump wants a deal. You heard him say it several times in that clip. We think Zelensky wants a deal because he wants the war to stop and Ukraine is losing that conflict right now. But what we don't know is if Vladimir Putin wants a deal. And we don't know what his incentives to get one are. It seems like he can keep the land. That's not really in dispute at least by the Americans. They'd be happy to carve out that part of Ukraine and give it to the Russians. Can he get sanctions relief? Now, obviously, these sanctions have been sort of harmful for the Russian economy, but they haven't really hurt the Putin regime in any meaningful way. And Putin seems to benefit from this permanent war that he's waging against the West. So it's really unclear to me, and I think Donald Trump is now hinting at that post-election, what incentives that Putin has to sit down and get to the table and get to a deal. The Ukrainians are acting like they recognize that they need to put increased pressure on the Russians. And they're acting like they recognize that a ceasefire would be in their benefit, which explains some of their recent actions over the last couple of months, including their own invasion of Ukraine, the meeting with Donald Trump last week, trying to convince him to put together a package that's more favorable to them, and then today's assassination, which they took credit for. So these things are probably about ratcheting up pressure on Putin. At this point, I would expect the United States to do more of that in the Trump administration. Trump's national security advisor, Mike Waltz, has talked about the need to tighten on sanctions on Russia so that they are getting able to sell less of their energy abroad. And he's talked supportively about Biden's decision to fire more long-range missiles into Russia, which Trump, of course, says he doesn't want to do. So, we are quite a ways away from a deal, it looks like right now, and it's possible this war continues to escalate into the first half of next year.
I want to pick up on that moment when Trump said yesterday he doesn't think the Biden administration should have allowed missiles to be shot 200 miles into Russia. At the same time, in his sit-down with Time magazine when he was named Person of the Year last week, he said the only way you're going to reach an agreement is to not abandon. So can we see an incoming Trump administration really tighten the screws on Putin, and then that's the reason to force him to the negotiating table?
Yeah, and this is an idea that's been kicked around Republican circles, Trump's former national security advisors, and other folks on Capitol Hill for a while now, that the trick to getting a ceasefire is to increase pressure. this view that the sanctions enforcement has been relatively weak, that all the oligarchs surrounding Putin are still wealthy and powerful, the ones who are still alive. And, there was a hope that they could pressure Trump into adopting this increased pressure tactic. And I think you're hearing Trump talk about that. Now, of course, Trump's all over the map on this issue. He thinks that, the way to get a deal is by striking up his friendship with Putin, calling him on the phone and having some discussions about why this is good for him and it'll all be great. Obviously, it's not as simplistic as that. And it would be a little bit ironic if now Trump pivots post-campaign to basically the Biden position, which is that you've got to continue to arm the Ukrainians to keep fighting here and fighting a war till they win it.
John, based on my conversation with sources, the Biden administration is going to be considering outright sanctioning Russian crude, something they have not done. They've just been using this price cap in terms to try to starve Putin of the money he needs to continue fighting this war. Do you think that that is just too little too late? Would the Trump administration welcome that? Or would they think potentially this could be inflationary and they're leaving the incoming administration with this inflationary bubble to deal with if that spikes oil prices?
I think the Trump's energy policy is just drill, baby, drill, right? Get more out of the U.S. and that'll offset any price pressures elsewhere. He's got a good relationship with the Saudis and perhaps he can get them to pump a little bit more to offset this, which is, again, what Biden did. So on the inflationary side, there's obviously global forces that would counteract that. The real question is how much pressure does that put on Putin? And I think Trump at this point would probably welcome that kind of pressure. Although the assassination today, I can't imagine that's a welcome development, given the possibility that this war continues to escalate. And Russia's got a lot of weapons they've left on the table so far that they could potentially use next, which is not something we've really seen recently, but I think is a concern for the incoming Trump team.
John, investors see the prospect of a Russia-Ukraine peace deal as one of the potential positive catalysts unforeseen right now for 2025. This, according to the Bank of America Fund Manager Survey. The other potential catalysts, positive ones, are U.S. tax cuts as well as potential AI productivity gains. One of the big negatives is a global trade war. Which of the options seems more realistic heading into 2025 to you?
I mean, we're going to get it all, right? So we're going to get. I think that you see these Ukrainian warrants rallying on the back of a peace deal. That seems reasonable, although it could take longer than perhaps Trump's been suggesting. The tariffs are going to go up. We know they're going up. They're going to go up probably at least on China, potentially on other trading partners, and if not on entire countries, then possibly on sectors like steel and aluminum. In the first Trump administration, perhaps the automobile industry is a place to watch for higher tariffs. One thing you didn't mention is immigration. Now, that's more of a domestic policy story, but it would fuel inflation if the workforce were to dramatically reduce starting next year with more deportations. And then fiscal, as you talked about with your last guest, fiscal policy, of course, remains loose. And I don't think anything DOGE does or is going to fix that. And there's not going to be any tax increases to offset that. So it's a really mixed policy picture next year coming out of the Trump administration. I wouldn't say it's at all clear that this is a pro-growth agenda, given the headwinds that are going to be introduced by some of this policy disruption. But you mentioned AI and cryptocurrency, and there's a whole bunch of other sectors that are going to do quite well in a deregulatory environment, which means you'll get some rallies in some places and then some headwinds in others.
John, it's good to hear from you. John Lieber there for Eurasia Group. Speaking of the auto market, is it a winner takes all? Tesla up again this morning by 2.9%. Vijay Rakesh of Mizuho, good friend of this program. The new Trump administration policies, including the EV tax credit repeal, positions Tesla better with lower EV cost structure relative to peers. I think this is a really important point that doesn't get talked about enough. He wants those credits gone. And this is why. Because essentially it costs less to make Teslas, and they've actually made it more efficient to manufacture, which is the reason why he doesn't care. And there's the hope of FSD. Record high after record high for that stock. Dan Ives of Wedbush coming up on the programme a little bit later. Up next, we'll catch up with Sharon Miller of Bank of America on the state of small business in America. The opening bell about 2 hours away. Retail sales in America 60 minutes from now. Equity futures on the S&P 500 into all of that, negative by about 0.33%. Let's get you some morning movers. Let's cross over to Manus Cranny for more. Good morning, Manus.
John, good morning. Take a look at NVIDIA. When you hear from Satya Nadella, could be one of the biggest customers of NVIDIA, saying to the market, power, yes, I'm short of power, but I am not chip supply constrained. And therein lies the conundrum. This stock is now in a correction, down for 7 out of the past 8 sessions, down 4.5% in December. Breathless on the downside. Look, the question you need to ask yourself is, every sort of major correction in this stock, is it an opportunity? Because the dip on NVIDIA is mirror imaged on the other side with Broadcom. You know, Broadcom's having its NVIDIA moment, so to speak. Up 38% in 2 days, market cap now over $1 trillion. And this is about the propulsion on AI growth. This takes me back to May 2023, when NVIDIA just blasted the market, and we just didn't expect the kind of guidance and numbers that we got from them. Bank of America say the AI story for Broadcom is growing at 3x over the next 3 years. There's plenty of room for other winners. It's trading on 38 times a multiple, so there is limited room for error. As we know, these are high wire acts. Let's round it off with Pfizer, reaffirming to the market 2024 outlook in terms of revenue, $61 to $64 billion. Our COVID products going to be pretty much the same next year as they are this year. However, the IRA, there's going to be changes in the Inflation Reduction Act. That is a redesign of Medicare. That is assumed in their numbers of around $1 billion. But that reaffirmation of the revenue is the key point of the 3% bid this morning. John.
Manus Cranny, thank you, sir. A rally for that stock. Under surveillance this morning, Ukraine claiming responsibility for the assassination of a Russian lieutenant general. Sources telling us here at Bloomberg, Ukraine's security service carried out the attack, an explosive device detonating near the entrance to a Moscow apartment building.
So this is a rare example of an assassination of a top Russian general inside Russia, and Ukraine claiming responsibility. It came a day after the Ukrainian secret services accused Igor Kirillov of ordering the massive use of banned chemical weapons against Ukrainian troops in the country. But it also, I think, spells the fact that they know that they're going to be forced into this potential negotiation. We were just talking with John Lieber about. So they're taking any moment at the tail end of this year, early next year, I think, to really try to push the Russians back and get as much as they can before they're forced to a table.
It seems like people are treating this as though escalate to de-escalate. And that seems to be sort of the understanding in markets, and that's how it's being treated. I just wonder at a certain point how much that maybe is a bit of a rosy interpretation, given the fact that Vladimir Putin doesn't take well to, black eyes.
Well, when it comes to escalate to de-escalate, it's not just potentially the United States, which Trump was saying in Time magazine, I would not abandon them, but also this morning, the European Commission saying it is prepared to end the transit deal of gas between Ukraine and Russia. Once again, trying to starve Putin of those funds he needs to continue conducting his war.
It's quite an escalation, that's for sure. Let's turn to this story. TikTok and its parent company ByteDance asking the Supreme Court to block a US government ban set to begin on January 19th. The platform asking the court to put the measure on hold by January 6th as justices consider whether to hear an appeal. Lisa, I think you and I are both on the same page. If there is a national security risk here, it doesn't matter about anything else. Nothing else matters. This is the only thing that matters. If you believe there is a national security risk, I don't care about the kids on TikTok. I don't care about whether you've got a donor who helped win you an election. I don't care whether Gen Z helped you win an election. If there is a national security risk, there is nothing above that at all.
It comes down to what is a national security risk and where is our standard for that. I will just put this out there. A Pew Research survey released in September showed that 17% of U.S. adults regularly receive news from TikTok. That is a 5-fold jump from 2020. If people are concerned about misinformation, about a manipulation of data, about any of these issues, well, this is quite clear. If they're not, well, make that point. I think that is really where our focus needs to be.
Well, Trump's former national security advisor had told me once that this is the Chinese Communist Party's greatest form of espionage into the United States. And if people are so concerned, and these TikTokers are concerned, and the company's so concerned so much that they went down to Mar-a-Lago to have a meeting with Donald Trump, well, then sell it. Divest. If you don't want it banned, divest.
National security risk on the phone, in the skies. The White House saying there's no reason for alarm as law enforcement investigates thousands of drone sightings in New Jersey and nearby states. This is President-elect Donald Trump suggests officials are keeping Americans in suspense over the sightings. He's implying that they know and that they're not sharing that information with the general public.
I'm a little bit frustrated here because we've talked about the range of potential options, and people are sick of this. The fact that Mickey Sherrill, a representative who used to be part of the Navy, she was a Navy helicopter and aircraft commander who is a New Jersey representative, basically saying there is a lack of coordination and communication among some of the authorities. Is there the authority to even talk to each other about what the drones are, the SUVs in the sky that people are finding above their houses?
What was interesting is after Trump said they know and they're not telling people, he was asked, well, are you privy to these briefings? And he said, I'm not going to talk about it. Well, he's an incoming president. We do know that, say, Jake Sullivan is speaking to Congressman Waltz. We do know that there is coordination. So I assumed that, yes, he's privy. And what he's saying is that maybe it's not too dangerous, but why are they not telling you, even though they keep saying they're quote unquote on it? Maybe they should give more details. Trump clearly knows.
Interesting. Watch this space. Let's turn to business sentiment. According to the National Federation of Independent Business, small business confidence has jumped above the 50-year average for the first time in more than 3 years. Bank of America releasing their year-end small business checkpoint, writing, that's not to say there haven't been challenges. Small business debt levels are rising alongside a cooling labour market, but credit availability is increasing as our capital expenditures, suggesting some of the rise can be attributed to future expansion and to growth. Sharon Miller of Bank of America joins us now for more. Sharon, good morning.
Good morning.
It's good to see you. Let's talk about the change in sentiment since the election. Are you seeing the same thing? Are you seeing a big bounce?
We are seeing optimism out there, and I think we've seen this over the past few years. So, but I do see as we come to the end of this year, business owner optimism has increased, and we are seeing capital expenditures, people thinking about the future and what that can hold for their business in 2025 and beyond.
So you're not just seeing a change in feelings, you're seeing a change in behaviour. They're
In
actually starting
activity.
to make those decisions. You're seeing that activity already.
We are seeing activity, and we're seeing loan growth picking up. We're seeing lines of credit utilization uptick. And so that is a good sign for what's happening in the business sector. So we handle clients from startup all the way to 50 million in revenues. And so from small to mid-size, we are seeing an uptick in activity.
One of the fascinating aspects of the recent report that you put out is that the biggest risk isn't necessarily weakness from consumers, isn't necessarily weakness in ability to sell. It is the potential for inflation to be stickier and eat into margins. How much was that a surprise to you at a time where we keep talking about the disinflationary trend that everyone's expecting into next year?
Well, it's not a surprise because inflation has been sticky. And as you think about business owners, particularly in their rental space, so where they're doing business, that has increased significantly. And so as you think about even retailers, they're paying 30% more on average, just because they want to get a good spot so that people see them, they're visible. And those rents have come up a lot. And so that has been on the minds of business owners, not just this year, but we have seen it more pronounced.
It raises this question of the vulnerability if there is some sort of increase in tariffs, particularly for smaller businesses that might have more difficulty than larger ones negotiating more better terms, et cetera. How much was that something that you talked about with them, that you're hearing more from your clients about how to maneuver in an inflationary environment where there still are opportunities?
Well, we're not sure exactly how that's all going to play out, and it will determine, how the health of the business is at the time once these tariffs, if they do go into effect. But, it depends. Are they going to keep it themselves if the health of the business is strong, or are they going to pass that along to the consumer? So that could have some inflationary impact as well.
When it comes to these small businesses, whether it's goods or services, who's feeling more optimistic?
I would say the services sector. We are seeing, services. We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. So people are spending on, memories. How do they take trips, and what are they doing that they can, continue to do? So we see that into the business segment. We're seeing an uptick in not only, travel and lodging, but also in other services, so professional services, finance. You are seeing an uptick in those businesses.
You say inflation remains a top concern, but even for small businesses, but even with inflation potentially lingering as this concern, do you see any appetite for consumers to slow down?
We have seen a very steady consumer. And so as we look at our data through the consumer reports, we see that their balances are 30% higher than 2019. And so we continue to see strength in the consumer in all cohorts. And, they are spending, and we've seen an uptick in holiday spending going into the holiday season. And so, there's still strength there and still some dry powder.
You talked about how there is a willingness and ability to increase leverage. And you are seeing more borrowing, even though there is a bit of credit card debt already outstanding for some of these small businesses. Can you talk about how different that is than, say, a couple of years ago, when maybe the scars of the pandemic were hanging over businesses and they weren't as willing to borrow? How much do you expect borrowing to really increase?
Well, we are seeing increased demand. And as you think about the balances on card, we do see an uptick, and that's not only due to the inflationary pressure that's happened over the past year, but also capital expenditures. And so we are seeing that pull through. But we have a strong business economy. When you think about the credit and clients that are out there in the communities really rebuilding.
Can they handle interest rates where they are? Because we get conflicting reports about that. What do you see?
They are handling the interest rates where they are. And again, we are seeing today we'll have another decision on, and we expect another 25 basis point decrease in the rate. And so, you know, it will help as rates come down. I think it will be easier for consumers as well as businesses to
But you're not picking up on any stress at the moment. I think that's important.
We are not.
That's interesting, particularly when the Federal Reserve is going around saying they think they are sufficiently restrictive. At a time when we see markets at all-time highs, credit spreads super tight, and then you hear that on small businesses, that it's not killing them. It's not hurting that much.
And at the same time, they're actually even increasing their borrowing despite some of these rates. So you have to wonder, do you end up with that increase in borrowing even if rates stay around here? And that's one of the real key questions that a lot of people are wondering.
Sharon, super smart. And good to catch up with you. Appreciate your time. Thank you. Sharon Miller there of Bank of America on small business lending and what's happening with those small businesses across America right now. Speaking of the fixed income market interest rates, yields a little bit higher today, up by 3 basis points. The 10-year 4.43, Lisa, the 2-year up to about 4.30 at the front end of the curve.
We've been talking about this. The reason why we have seen that uptick recently is because of this belief in stickier inflation, and it goes to exactly what Sharon is talking about, which is the key question will be passing along some of those increases in costs and the fact that a lot of these businesses can tolerate borrowing at levels that are currently in the market.
That Federal Reserve decision just around the corner. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. President-elect Trump says Ukraine needs to make a deal with Russia to end the invasion and downplay the value of occupied land. That may signal a Trump push for a settlement that codifies Russian territorial gains. Speaking at Mar-a-Lago on Monday, Trump again criticized the use of U.S. weapons to strike targets deeper into Russian territory. Pfizer shares moving higher in the pre-market trade by 3%. 2025 sales and revenue were in line with estimates, helping Pfizer fend off activist investor claims about mismanagement. It said sales next year will be between $61 and $64 billion. Shares year to date down just over 12%. People familiar tell us that Volkswagen's management and labor leaders are still far apart from a deal. After talks in Hanover yesterday, VW's CEO and human relations chief are set to tell the board that prospects of an imminent deal are dim. People familiar say today's negotiations are expected to go late into the night. A breakthrough must be made by early Wednesday, or the union will vote on walkouts to take place in January. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, big tech cozying up to Trump.
I had dinner with sort of almost all of them, and the rest are coming. One of the big differences between the first term, everybody was fighting me. In this term, everybody wants to be my friend.
It's a big difference, a big change. We'll discuss that next with Dan Ives of Wedbush from New York. This is Bloomberg. So here's the stock market picture. Equities down just a touch. We're down 0.33% on the S&P 500. Bond yields a little bit higher, up by 3 or 4 basis points. The 10-year at 4.43. Just to set the stage for the next 24 hours, in about 43 minutes, you'll get US retail sales. Then tomorrow afternoon, 2 p.m. Eastern Time, a decision from the Federal Reserve at a news conference with Chairman Powell 30 minutes after that. And the surveillance this morning, big tech cozying up to Donald Trump.
I did have dinner with Tim Cook. I had dinner with sort of almost all of them, and the rest are coming. One of the big differences between the first term, everybody was fighting me. In this term, everybody wants to be my friend. I don't know. My personality changed or something. It's a big difference. The big difference is that The first time everybody was fighting me on all fronts.
It's a big change, and here's the latest. President-elect Donald Trump hosting a series of meetings with top tech leaders, including Meta's Mark Zuckerberg, Alphabet's Sundar Pichai, and Apple's Tim Cook. The incoming president sharing plans to meet with Amazon founder Jeff Bezos sometime this week. Dan Ives of Wedbush raising his Tesla price target to $515, writing, "We believe the Trump White House over the next 4 years will be a total game changer for the autonomous and AI story for Tesla and Musk over the coming years." Dan joins us now with quite a punchy price target. Dan, good morning. It's good to see you.
Great to be here.
Vijay Rakesh of Mizuho doing something similar this morning. He makes a different point, though, and I'd love your thoughts on this. He says the new administration's policies, repealing the consumer EV tax credit, positions Tesla better than lower EV cost structure relative to peers. How important is that piece of the puzzle?
Well, I think that's important because, again, negative for the EV industry, positive for Tesla in terms of the scale and scope. But if you look as they sort of do the sweep the leg on the EV tax credits, that's just going to give Tesla more and more of an advantage. But let's just be clear, that's the appetizer. I mean, the main event here, what we are focused on, the gold at the end of the rainbow, it's autonomous, the AI future. And I think that's where the light bulbs went off, because if you look at the Trump-Musk bromance, and as this all plays out, this is really going to be, I think, it's a poker move that I think will really be the bet for the ages when you look at Musk's bet on Trump.
The vibes are good, and it's hard to fight against them. I just got a message from a Bloomberg subscriber. I won't mention their name. I believe you know the individual, and we can talk about that in the commercial break. And this is what they say. Tesla has increased since the election by something like $700 billion in market cap, now $1.5 trillion. The business is not growing and hasn't in 2 years. Despite the hopes for full self-driving, it still doesn't work. So less regulation doesn't help it work. It's up another GM in market cap this morning, or better, the market cap of Waymo, which actually has working robo-taxis. My prediction for 25 is Tesla will lose over $1 trillion in market cap. What would you say back to that individual?
I'd say if that person was an NFL scout, they're probably negative on Tom Brady, coming out of the 2000 draft, coming out of Michigan. I mean, the point is look, despite all the Super Bowls, look, if you look, the Bears, they can't see AI in the spreadsheets. So when they're sitting there in hibernation mode, they don't understand this move. Autonomous is worth $1 trillion valuation to the Tesla story. And I believe now, as this all plays out, it's really just the start. I continue to view this as probably the best pure AI play out there.
So I guess if you want to build on that, it might be that this person isn't looking necessarily at the same kind of $1 trillion addition to the market cap. But then if you spin that the other way, why isn't this promise also lifting the stocks of, say, GM, which, yes, got out of the possibility of robo-taxis on its homegrown turf, but is partnering with others to do the same thing and isn't being valued at all in that increase?
And I'd argue you look at Alphabet. I mean, Waymo, a big thing that we've talked about with Alphabet, the reason it's a table pounder, some of the parts, Waymo is going to be a huge benefit for them, too, when it comes to autonomous. But look, this is being led by Musk and Tesla. In the Mount Rushmore, they are going to continue to own this because you have 7 million vehicles out there going to 10 million. You look at GM in terms of the Cruise, that's a black eye situation. I ultimately think down the road, they could OEM technology from Tesla when it comes to autonomous and full self-driving. And that's why, you look at this beltway, the difference now is that Musk went from sort of the enemy to now he's going to have a game. It's a game changer relative to the federal regulatory landscape that I think Musk could help change.
Just to crystallize what you're talking about, some people say he invested $277 million in Donald Trump's campaign, and he gained his net worth $200 billion in the process. It seems like a pretty good financial trade. There is a larger question here about FSD, and this question of, are we better off with a market leader because of a status, not only just simply because of that technology? To the writer's point, there have been pitfalls in the full self-driving technology for Tesla. There have been accidents. There have been some real questions around whether it's ready to go. How much does it make the system more fragile to roll it out at a time where there is one entity with such favor?
Yeah, sure. And I think, again, this is going to be rolled out in a staged process. And our whole view is just when you look at now the new landscape, it's going to give Tesla a much greener pasture when it comes to autonomous over the coming years. And I ultimately believe Cybercab, is that what we talk about robotaxi today? this is going to accelerate that vision and make it real. And Lisa, I think the other thing is that when you look at Optimus and you look at robotics, as we've talked about in the show, that's not even factored in from a valuation perspective. I continue to view overall, in this AI party, it was 9 p.m., but now it's 10 p.m. The party goes to 4 a.m.
I'm usually in bed by then.
But party goes to 4 a.m. And
Just for
now,
the record.
behind those velvet ropes, now you let software in. Benioff, let him in. You have other software players coming in. Others are going to get on the party, but it just goes back to where I believe we are going in 2025.
All right, but to bring back up the point of the Debbie Downer viewer that's writing in about what you have to say, you're really talking about a vibe. But where is the technology right now? How much longer do we need to wait for this type of technology?
I think a year from now, we're talking about when it comes to autonomous and it comes to FSD, when you think about where we need to get the FSD penetration above 50%, I think a year from now, we'll be there. And I think a big blockade here has been the regulatory spiderweb in the Beltway. Look, as we always say,
the spiderweb won't matter if the technology is not there.
But I believe the technology has advanced significantly. If you look right now, if you look at V13, you look at what they've been able to do. But look, haters continue to hate.
Don't look at me.
No, look, and the point is like they hated 100 billion, right? Hated 500 billion, despise it $1 trillion. At $2 trillion, they'll be yelling from the mountaintops. But it goes back to just like in broader big tech, this AI revolution is here. It's a 1996 moment, but it's not a 1999 bubble moment. And Musk and Tesla are going to play a huge role in terms of what we see the autonomy.
There's another name I want to squeeze in before you go. You've talked about it a lot. Palantir. Why doesn't that get talked about more? The run it's seen so far in 2024.
It's the Messi of AI, right? I mean,
it's up 350% this
But
year.
I believe to me, it could be ultimately the next Oracle, the next Microsoft. And that's why, look, the haters, they hate it as a teenager, despise it as a senior citizen living in Delray Beach. So that they hate it at 13, despise it at 75. But I believe it's just the start of when it comes to AI revolution, this is the best use case. Carp is up there in that Mount Rushmore, along with Godfather of AI, Jensen, NVIDIA, and Nadella, and others.
What's Carp doing right?
Carp understands, I think, AI use cases. The algorithms they built are unique. And there's no other, I think, there's ultimately AIP, there's no other software that matches them. And I think Palantir has one institutionally been shunned. Retail clearly has been, I think, a bit ahead. Just starting in terms of our view of the broader Palantir story. But as I always say, the bears, they can find AI in the spreadsheets when they're in hibernation mode.
Dan, it's good to see you.
Great to be
Dan
here.
Ives of Wedbush. I'm not sure about the Tom Brady Michigan comparison with a market cap of 1.5 trillion, but I'm not sure that works.
Look, it goes back to just early days, right? In terms,
Okay.
but again, bears can see the greatness.
Bryce Young, Alabama Heisman winner, like that kind of works. Bit overvalued.
I would say it's somewhere.
Didn't work out.
Again, and Bryce Young, don't count Bryce Young out, too.
I like Bryce Young.
Yeah, I'm
I
actually
too.
bullish on Bryce Young.
Yeah, I hope he makes a comeback. Mike Wilson of Morgan Stanley up next. It's good to see you, Dan. Thank you. The JetBlue CEO, Joanna Geraghty, Blerina Uruci of T. Rowe Price, and Amanda Lynam of BlackRock in the third hour of Bloomberg Surveillance. Up next.
I think growth has surprised to the upside since the election. It's just harder and harder to justify owning non-U.S. developed markets.
Returns have really been driven by a narrow collection of stocks. Narrow stock leadership is fragile stock leadership.
There's clearly this awakening of animal spirits. The attitudes from the sell side today are remarkably different than they were a year ago.
There's enormous optimism about the U.S., but we don't know about what this new administration is going to do.
Sentiment is very positive, but I think sentiment is positive for a reason. The economic growth's been surprising to the upside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with a snapshot of the price action going into the opening bell in about 90 minutes' time. Equity futures on the S&P 500 negative and near session lows. We're down 0.4%. Underperformance once again on the Russell. The small caps down by 0.2%. 5.6. In about 29 minutes' time, retail sales in America, the last big data point before the Federal Reserve meets. That meeting a little bit later on today, concludes tomorrow afternoon at 2 p.m. Eastern Time, and then we'll hear from the man himself, Chairman Powell.
A lot of this comes down to what they signal for 2025 at a time where people think the economy is doing pretty well. Yesterday's services PMIs came out much better than expected. It raises this question: at what point will the strength of the economy translate, maybe not into much lower rates, but at least into the broadening out in some of the equity trends that we haven't seen over the past couple of weeks?
Andrew Hollenhorst just publishing, talking about resilient consumer spending. We spoke to Sharon Miller of Bank of America, talking about even with a little bit stickier inflation across some of the sectors, they are still seeing consumers going out and wanting to spend. The resiliency of this consumer, which brings you to the Wall Street Journal editorial board this morning that is saying, why, Jay Powell? Why are you hiking yet again, cutting yet again? And this would mark a full 1 percentage point reduction when you see how financial markets have already reacted, how the consumers are already reacting to your previous cuts.
The financial markets sky high, equities at records, credit spreads super tight. We talked about triple C's, the junkiest of junk. Have seen a huge rally since the summer. Embrace the bubble. The message coming from Barron's over the weekend. Then you look at sentiment from the Bank of America Global Fund Manager Survey. Cash levels, record lows.
Yeah, 4%, which they said is the second contrarian sell signal at a time when people can only come up with reasons to sell, like everybody is bullish, so I feel worried. There is a feeling where it is hard to understand what the sell trigger will be without that sort of catalyst from some sort of external event. At the same time, I do think it's notable that we're not seeing the broadening out. I am worried about bad breath.
Every single day so far in December, continued yesterday too.
11 days that there are more losers than gainers. That is the longest streak in about 40 years. You're looking at this and wondering, what are people on the ground from the bottom up worried about? The people from the top down just aren't.
This from Bank of America. Bubbles can last longer than you can stay underweight. It's been painful to be bearish through 2024. Coming up this hour, we'll catch up with Mike Wilson of Morgan Stanley as tech stocks hit another all-time high. JetBlue CEO Joanna Geraghty on the demand for premium travel options, and Amanda Lynam of BlackRock on the Fed's rocky path in 2025. We begin this hour looking ahead to US retail sales at 8:30 Eastern before the last Federal Reserve decision of 2024. Mike Wilson of Morgan Stanley seeing better balance for next year, saying we see more balanced EPS growth in 25 for the S&P 500. This should lead to better breadth, something that has been absent over the last 2 years. And Mike Wilson absent over the last few weeks. Good morning. What's happening?
Well, this is the debate, right? So I think what's happened is we got the broadening out in the fall on three things. A, we priced out the recession risk, which was kind of creeping into markets. The Fed went 50, which, was a surprise and maybe not even necessary. And so that got people juiced up. And then, of course, we had the election. And I would say the election was positive for two reasons. We talked about this last time. One, we got a Republican sweep, which markets tend to view more positively. But more importantly, it was definitive. And so a lot of those hedges came off. And those hedges were in some of the lower quality areas. And so I think that kind of basically pulled forward the initial move on the broadening out. And now what's happening is because rates are back up, there's some concern about the Fed not being able to cut perhaps as much as people thought. And so we're seeing a de-risking kind of into year end, or just some profit taking, quite frankly. So we'll see. I mean, look, when you read the note, but I mean, we said we think there's a broadening out. That's not what we think. That's what the consensus thinks. Okay, so in other words, that's the expectation. If the consensus numbers are hit next year, bottoms up, we will see a broadening out. That's the key. It's about earnings revisions. And we're just being a little more selective on that. So we upgraded, financials. We've been more constructive on software, some of the industrial names because of the earnings story. And that's how we're going to trade this for the next 3 to 6 months, is we're going to look for the areas where revision breadth is improving. It's not going to be universal. This is not like coming out of a new cycle. So I want to make that perfectly clear to listeners that we're not expecting a broad rally in the way like 2020, 2021, where the low quality stuff, everything goes up. It's going to be more rifle-shotted to the areas where growth is improving.
Let's sit on that distinction. It's not a new cycle, it's a late cycle extension. That's what you're calling it.
That's right.
Why is that so important? What's the difference between the two?
Well, we're getting what we usually get. We called it classic late cycle back in 2017. It's actually the most bullish part of the cycle because the Fed is moving, multiples expand. So let's just talk about what happened over the last 12 months. That's exactly what's happened. Earnings estimates have not gone up for 25 and 26. They've just rolled forward. Multiple went from 17 times to 22 times. That's very typical in the late cycle period. You typically get narrowness, which is what we're getting right now. The quality stocks have continued to work with this back and forth, this uncertainty around, oh, is it a hard landing? Is it going to be a reacceleration of growth? Is the Fed doing enough? Are they behind the curve? Are they ahead of the curve? And that creates these really opportunistic rotations.
How much is this late cycle trend turbocharged by the idea that there is no alternative than the United States right now?
Well, that's a very good point, Lisa. I mean, we wrote about that in our last note about a month ago, or that monthly note that we put out, just saying, you know, we were in Singapore talking to investors all over the world. There's just no interest for anything except the U.S., this U.S. exceptionalism idea. You know, I think Trump winning just makes people, it's like a magnet because it's like, oh, they're just going to put all their resources now internally. And so that helped. And I think that's price. That's what the markets are saying. Okay, the markets are basically saying that's correct. Now, is it overpriced? Potentially. I mean, clearly in some stocks and sectors it's overpriced, but that move is not wrong. I think the markets, I think investors are just seeing what's right in front of them. They're saying that America is going to take share. You know, America has this America First agenda.
When you talk about a sort of a rifle shot, you have to look at the areas of growth, and you've talked about the rotation in themes and that this is a market searching for a new theme other than AI. And I'm just wondering what's on your bingo card in terms of the theme that's going to pop up next that could be really transformative for investing trends.
Exactly. And so we're trying to find areas that have not yet recovered from what I would say we've been in a 2 to 3 year recession now. In the private economy, we've been in a recession in housing, manufacturing, IT spending away from consumer goods. So there's been a lot of things that have been beaten up. So we're looking for the next thing where there could be a reacceleration. 2 areas that look interesting. We're not there yet. Consumer goods, where inflation actually maybe is picking up now, which is actually good for earnings. And the second one's transports, which have been in a depression because there's been no restocking. There's been no kind of pull forward. And so if animal spirits come back, those are 2 areas where we think there could be life. Now, like I said, we're not there yet because we haven't seen a revision breadth bottom out, but those are on our bingo card.
But on the flip side, what is potentially others you can see in this move into maybe depression mode?
Well, I don't think there's a depression. I think, but there are areas that are probably going to see a deceleration. So, for example, semiconductors have been trading terribly, mostly because they're in a deceleration now, except for a handful of stocks really benefiting from AI. I mean, if you mention AI, you benefited, but the reality is it's a handful of stocks that have actually seen that spending increase. And the traditional semiconductors actually got bid up on that idea now are selling off in memory and analog, some of the more commodity areas. So that's actually happening right now. I think we're going to see some of that maybe in consumer services, where we're seeing a deceleration in inflation. Now, a little adage that I think people don't appreciate is, you know, average stocks do better when inflation's accelerating. Right, because that's their pricing power, that's earnings growth, that's 2020, 2021. And we've seen this divergence between consumer goods and consumer services, where services have had pricing, goods have not. And now, if you look at some of the data in the CPI, which I know you follow closely, we're seeing services decelerate and goods are actually starting to bottom out. They're still negative, still seeing deflation, but that's starting to turn up.
When it comes to the most bullish catalyst for next year, the Bank of America Fund survey talked about China, reacceleration, AI productivity gains, a peace deal in Ukraine, and U.S. tax cuts. What do you think would be the most bullish?
Well, I think U.S. tax cuts are kind of off the table in terms of incremental. Now, I could see an extension of what we've gotten, and that's sort of just, I don't think that's an incremental positive like it was in 2017. So I take that one off.
Status quo.
Yeah, I mean, if they don't extend it, then it's a real negative. I think that's the way I think about taxes. I would say on the peace deal, I mean, that's, okay, I mean, yeah, we're all hoping for that, but I'm not sure there's an investment opportunity in that. I mean, like a lot of people are bullish on defense stocks, so maybe that actually peels off. So that could be somewhat of a negative for certain areas. I would say that the productivity thing on not only AI but productivity in general. I mean, are we going to get more productivity out of people because we're not allowing as many immigrants in anymore? We need to find labor productivity. If we don't get labor productivity, that's going to be a real headwind for businesses. So I think that's a big one. Some of it's AI related, some of it's just getting people more efficient. Look, people are still getting back to work in the office place, quite frankly. You know what I mean? I mean, the one that I would put on
federal government.
Yeah, when I would put on the card, and this is more of a 26, 27 story. Can we get more efficiency out of the government employees who are not bad workers or bad people? They're just maybe playing for a bad team. We talked about this last time. Can we get those people, repositioned in the private economy? As the private economy now is starting to recover.
You said something that I want to pick up on, that companies tend to do better when inflation is accelerating. And this kind of flies in the face of what a lot of people are expecting for next year, that the disinflationary environment is going to be a Goldilocks nirvana for equity valuations. Right. How much is, if the Fed gets what they want, and if we actually do see disinflation, that could be one of the bigger risk cases to equities that have benefited from an acceleration in inflation that has given them pricing power?
Totally. Multiple will come down. Okay, so I think this is an index risk, and we, I've been thinking about this for a while. So we had this rally from the summer where the average stock did better, right? Look at just say S&P equal weight versus market cap, and that was a pretty powerful rally. It's giving up almost all those gains now, and it looks to me like we're going to make a new low in that ratio. Like we're going to retest the lows in the first quarter, meaning index market cap is better than equal weight, and that's the low that I want to buy. Now that could mean that maybe inflation is stickier, that pricing is better, earnings end up being broader, okay? And you see a rotation where the average stock does better than the index. Now that could also mean an index level correction of 10 whatever % plus, but that the average stock does better. Same thing, by the way, happened in early 2000. So it's a very similar setup where 2000 was a great year for the economy, okay, but the index came down because the high flyers came down as rates went up, and the average stock actually did quite well. So that's an interesting kind of thing that we're looking at. I think it's too early to do it now before year end because this is kind of monkey time for the last 2 weeks of the year. And people are just,
What's monkey time, Mike?
Monkey time
this is monkey time.
Yeah, I mean, we're
sort of like
marking up positions, like it's just everybody wants to get to the holiday. I mean, so no one's really taking big bets right now. That's my point. And I think the first quarter could be interesting in this regard.
Correction in Nvidia. We're down by a little more than 10% off the highs in November. What do you think is going on there?
Well, I mean, there's a deceleration going on, right? I mean, gross margins peaked earlier this year. We're seeing a deceleration in growth, still very robust, okay? This is not like a situation where they have a problem. It's more of just that, hey, this thing priced a lot of good news. It's kind of gone sideways since the summer. It's digesting that. We're seeing a rotation into some other AI winners. That money's moving. That's normal. I don't think there's anything nefarious with that.
Mike, appreciate your time.
Great to see you.
Enjoy the monkey time. Into the weekend. Mike Watson there of Morgan Stanley. Equity futures session lows. We're down by almost 0.5% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukraine claimed responsibility for the assassination of a Russian general in a bomb attack in Moscow. According to people familiar, Ukraine's security service carried out the killing of Lieutenant General Igor Kirillov and his assistant. Russia said the two servicemen died when an explosive device planted on a scooter detonated near the entrance to an apartment building. Investigators have opened a criminal case for murder. Israeli officials say a ceasefire agreement with Hamas is more likely than it has ever been over the past year. A working group from Israel is in Doha this week, reestablishing relations with mediators. Details are mostly under wraps, but two Israeli officials said the ceasefire would occur in stages, the first of which would be to free hostages that are women, ill, and older than 51. The CEO of TikTok met with Trump at Mar-a-Lago yesterday, just weeks before the popular video app is expected to be banned in the U.S. over national security concerns. The private meeting came just hours after Trump suggested he'd somehow try to reverse the ban to save TikTok, which he used to reach young voters on the campaign trail. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the morning calls. Plus, we'll catch up with the JetBlue CEO, Joanna Geraghty, in just a moment as consumers continue to splurge on premium travel. That conversation up next. Equity futures on the S&P down about 0.4% on the S&P 500. Bond yields higher by 3 basis points. The 10-year 4.43. Let's get you some morning calls. First up, Mizuho upgrading Tesla to outperform, citing an improved outlook under the incoming Trump administration. That stock is up by a little more than 2%. Your second call from Jefferies downgrading Match Group to hold, pointing to weak revenue trends for its Tinder app. That stock is down by 1.8%. And finally, Telsey Advisory upgrading Albertsons to outperform, highlighting growth potential following the termination of the Kroger merger. That stock is up just a little bit by 0.75%. Turning to consumer spending, JetBlue planning to expand its first-class offerings in 2026 as passengers continue to pay up for premium options. The carrier also cutting capacity to increase fares and focus on East Coast leisure destinations. Joining us now to discuss is the JetBlue CEO, Joanna Geraghty. Joanna, good to see you.
Thanks for having me.
The demand for premium is through the roof, and a lot of people are trying to provide the capacity for it. What gives you the impression, the confidence that that demand's going to stick around?
I mean, JetBlue's been doing premium for 10 years. We introduced our Mint product 10 years ago. This is just continuing to round out the suite of products that we have. We have a great coach experience. We have even more space, Mint Lie Flat, and now more of a domestic Mint, domestic business class seat that we're going to be introducing in 2026. Very excited to bring it to customers in leisure markets.
Food is best in class. I'll say that on your behalf.
Thank you.
I've done the flight in Mint to California and to London as well. Where does that come from? How expensive is it to provide that kind of product?
Yeah, I mean, we really look to provide a differentiated experience, and we lean in on certain areas. So food has been an area that we focus on. Comfort is another area that we spend a lot of time with. We have a great partnership with Tuft & Needle, and as we think about our new domestic first class, comfort's going to be the area that we lean in on there as well, with some interesting features of our seat product that provide a bit more comfort to customers.
How difficult is it to thread a needle with the likes of business class, given the fact that JetBlue traditionally has been an airline that caters to pleasure travel, to the idea of traveling with the family to warm places in the wintertime? How much does that kind of create a conflict for you?
You know, we don't think it creates a conflict because everybody's a leisure customer. And when you think about what you like to do on a vacation, sometimes you want an elevated travel experience as well. So we want to make sure that we have an offering for every type of leisure customer. One of the things we have done recently is kind of retrenched in the Northeast, really focusing on serving the best leisure markets out of the Northeast, Europe, the West Coast, down in the Caribbean. And there's a real market for that premium seat.
I guess another way to say this is businesses are willing to pay more on their expense accounts than individuals, especially when they're going on vacation. How difficult is it to charge the rates that make it worthwhile, given the fact that it's people going on vacation and they typically have budgets?
We're not focused on charging rates that are akin to what a business customer in a business would charge. We really want to make the premium experience affordable to leisure customers. When we introduced Mint 10 years ago, we did just that. We reduced fares to the West Coast. We introduced a better product, a better service, and that's what we're looking to do here. It's really important for JetBlue to make sure that we have affordable fares and that all of our products are accessible to the leisure customer. So that's the customer that we're targeting, somebody willing to pay a bit more, but not at the size that you would for a business.
You've been tasked with turning around the balance sheet of JetBlue, and you've made progress in that front. You just reported earnings that were positive and really pointed toward progress in that. How much are you able to raise prices at a time where you see increasing consumer pushback, but at the same time, there seems to still be that ongoing demand for travel?
There's very healthy demand in the peak, and that's where leisure travel is great. So as we think about, the holidays, we think about the summer time frame, that's where I think JetBlue does its best because we fly to some of these great destinations. Troughs are definitely more challenging. We've seen some pricing pressure in the troughs, and we've reduced a lot of flying in the troughs. So it's really about balancing out that year and making sure that, when demand is high, you're focused on trying to capture your share of that demand. And in the troughs, really reducing the losses.
So do you expect to increase fares this year?
We're hopeful that we can keep fares affordable that reflect the cost of service. It's more expensive to travel now because there are costs. Airport costs have gone up, labor costs have gone up. So there's meaningful inflationary pressure for the airlines as well. Our great food comes at a cost. When you start seeing the grocery costs go up, that means the food in an aircraft is going to go up too. So we're really trying to balance it and make sure that relative to the other travel out there, that JetBlue is an affordable fare for customers and accessible for a leisure customer.
Well, there's also been other constraints on the airline industry when it comes to getting the parts they need, comes to actually getting the planes they need to fly. And then next year, a lot of people are talking about, well, we might get tariffs and potentially that might impact the supply chain. How are you preparing for all of that?
Yeah, I mean, JetBlue has a unique situation with Pratt & Whitney right now, and we have a number of aircraft sitting on the ground that we're paying for, but we're not able to fly because they're due for an engine inspection, and there's not enough capacity to do those inspections. So that's definitely a headwind for JetBlue. As you think about tariffs, it's a bit too soon to tell. I think the good news for JetBlue is we take a lot of our aircraft from Alabama, but, depending on how tariffs get put in, we do have exposure in Europe and in Canada because some of our aircraft come from there.
Of course, the JetBlue Spirit Airlines potential merger was blocked. Are you potentially thinking about going at it again in the next 4 years in this space, more mergers and acquisitions, because there might be a lighter regulatory touch in Washington, D.C.?
We're really focused on delivering our new plan, Jet Forward. We want to see JetBlue thrive as a successful standalone company. We have a brand that customers love. We've got a great product, a great service. We're focused on flying in the places that people know us. So we're really focused on our standalone plan, Jet Forward, right now.
Okay, so you might not dip your toes back into that space, but do you think that this is going to be a more welcoming administration when it comes to things like mergers and acquisitions?
It's hard to speculate because we don't know exactly what the plan is going to be, but it's hard to see an administration that's going to be worse than the administration we had around antitrust.
In the meantime, you have announced a number of changes in terms of the Jet Forward, including closing down certain operations in a number of cities. I believe that they are going to cut, you're going to cut some 50 routes.
Correct.
Is it done? Are there more to come?
The network is always something that's evolving, so the majority of the changes are done, but we're not going to rest on our laurels. If a particular market is not producing results, then we're going to take a good hard look at it, see if we can improve it, and if not, then we're going to point those planes to a place where we can make money. We've got to become profitable, and part of that has made the need to make some tough decisions.
I've got to follow up. Have you spoken to the incoming administration?
We have not spoken to the incoming administration.
You're planning to go down to Mar-a-Lago anytime soon and make the pilgrimage?
Right now, I'm focused on holiday travel. We have 150,000 customers a day flying on JetBlue.
Palm Beach is a great place
over
for
the holidays.
For the sun for the holidays.
You can combine the two. What do we call that?
Yeah.
Workations?
Leisure.
Pleasure?
Bleisure.
Bleisure.
Yeah,
Bleisure. Okay, bleisure. You sing a lot of bleisure?
We see a lot of leisure. We see a lot of leisure over the holidays, too, though. And we're just really happy to be a part of connecting people with their families over the holidays.
What does the volume look like
About
at the moment?
150,000 people a day over the Christmas holiday. We've got about 1,000 flights a day. And, it's amazing when you think what airlines do and the magic that we can deliver to customers reuniting their families and making that great experience. It'll be busy. It'll be tough. And my hope is that everybody can be patient and a little kinder.
If you're asking for patience, does that mean there are going to be delays? How does this stack up?
Oh, you've teed that one up perfectly. Delays. I wish this administration would focus more on air traffic control. That has definitely been a meaningful pressure to JetBlue, to all airlines. When we think about this next administration, that is a real focus area for JetBlue.
What would you like to see change? What
I
can
would
they do?
love to see more hiring. I'd love to see better technology and ultimately improving the amount of delays that come out of the air traffic control system in New York in particular, which is the hardest hit.
We'd all like to see the same thing. No one wants delays, do they, Bramo?
You're talking to the choir. I've had, okay, honestly, going to Florida is the hardest, though. I have to be honest, because there's always weather. There are winds that come up. There's a random storm that comes up. And some people get delayed for a long period of time, and they sit there, and then their plane gets canceled, and they can't go on vacation with the whole family.
Or CEOs can't control the weather, though. Okay. But what is interesting is we have here an airline CEO saying they want the FAA to hire more. And the incoming administration is talking about dogifying the government.
It's true.
Well, hopefully they're not talking about air traffic controllers. We are grossly understaffed. And at the end of the day, those delays, even with weather, we should be able to have a more resilient aviation air traffic control system with weather. That is just something that we have to deal with.
Just pause for a second. Are you saying that all those delays, it's not because of weather? It's just
no,
because
some of the delays are definitely because of weather, but they are exacerbated because we are significantly understaffed among air traffic controllers.
I never trust the excuse. You've got a problem with trust as well. I never trust them. I never trust them.
I know what's actually going on. And actually, to Joanna's point, there is a problem with air traffic
The
control.
staff's missing
But
or
sometimes
something.
you can actually see how bad the weather is, and you're thinking, I would wait
then it's
for that.
the weather. But sometimes you look outside, the sky's blue, the sun is shining, and they're like...
Air traffic control delays.
Yeah.
That's a problem.
Come on. The pilot's missing, went out the night before. Who knows?
That's in Japan.
That does not happen.
That was wild.
Doesn't happen
That does not happen at JetBlue.
Just to be very clear. Okay. Joanna Geraghty, it's good to see you.
Thank you.
Appreciate your time. Thank you. Up next on the programme, we'll break some US retail sales. Those numbers drop in about 5 minutes' time. From New York, this is Bloomberg. Significant data point is just seconds away. US retail sales in just a moment. About 20 seconds away. Going into that data, equity futures on the S&P, negative by 0.4%. On a Russell, we're down by 0.5 in the bond market. Bond yields shaping up as follows. 2-year, 10-year and 30-year yields higher by 2 or 3 basis points. The 10-year 442.44. With your economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Let's call up the numbers here. They're just coming in stronger than anticipated. It looks like we had a pretty good November off the top here. 7/10 gain as opposed to a 6/10 forecast. That's up from a 4/10 gain the month before. And then in terms of ex-auto, up 0.2. That's lower than anticipated. Retail sales ex-auto and gas, 0.2 lower than anticipated. So it looks like a lot in the gas and auto range in the advanced number. Now, the control group is what we care about. It's what goes into GDP, 0.4%. bang on with the forecast, and it is better than the 0.1% decline that we saw the month before. We'll take a look at the categories here as you check the markets.
Right, McKee, I'll turn to the bond market first. The move just fading a touch. We're up a single basis point now on a 10-year, likewise on a 2-year. So let's call it 426 at the front end of the curve. In the equity market, we were near session lows, down by about 0.5% on the S&P. Recovering a touch, we're down by 0.4. So the headline comes in at 0.7. At least, so the estimate was 0.6. The revision is pretty decent. Control group comes in line.
Basically, we're looking at what looks like a distortion a little bit, particularly from auto sales. If you look just ex-auto and gas, that actually came in below expectations. I'll let Mike actually parse through the numbers. I will say the upside surprise, though, the upside revision is interesting to me. Things look better even than people previously thought, and this is part of the give back that people were expecting from the hurricane that we saw. But it was even better than people expected. Again, better than expected economic data is the theme of 2024.
And Mike McKee, take the opportunity to have a second look. What do you see in the details?
Well, it looks reasonably strong throughout, which is why the core is up. It is definitely distorted by autos and other motor vehicles. The advance number for auto parts and autos is 2.8% gain. That is reasonably strong. And gasoline prices on the month were up 1/10. We have seen declines in that category for many months, and now we get a rebound there. But other than clothing stores and general merchandise stores, most everything is up. Clothing stores were down 0.2. General merchandise department stores down 0.6%. Food services and drinking places, interestingly, off by 0.4. That's usually seen as the one discretionary category here, and it is the only services category in the whole thing. But furniture up 0.3, electronics and appliances up 0.3, building materials up 0.4. Now, we knew that would probably be higher because of the hurricanes rebuilding. And grocery stores down 0.2. So a real mixture here. Some strength in areas that you might be expecting, and then some declines in areas that would be related to the holidays. Let's see how it all turns out in December once people get to really shopping.
Mike, has there been a trend, I mean, aside from some of the hurricane disruptions, of increasing demand and increased spend on the goods sectors, on furniture again, on home improvement, on cars, on areas that saw pretty significant disinflation and even deflation over the past year?
Well, we have seen sort of change in that more people have been buying goods. Goods spending is up, according to the government figures that we had a couple of weeks ago. But does that continue? Is it really the hurricanes? Because you see a lot of cars sold when hurricanes and other natural disasters happen. People still got to get to work. They know their insurance money's coming in. They go out and buy cars. And of course, you've got the rebuilding in the home builders areas. What's interesting is that we saw a 0.9 rise in sporting goods, hobby and bookstores, which is the strongest one for the month here. And yet, department stores were down 0.6. So maybe we are getting more goods than soft goods this year.
Mike McKee, thank you, sir. Stay close. We'll go back to Mike in just a moment. Looking at US retail sales, if you are just joining us, they come in at 0.7% for the month of November. That's the headline read. The estimate in our survey was 0.6. The revisions are positive as well. Joining us now to discuss is Blerina Uruci of T. Rowe Price. Blerina, welcome to the programme. I want your opinion as to why people expect the Federal Reserve to cut interest rates tomorrow when the data seems to be pretty decent and equity markets are sky high.
I think the answer to that question is fairly simple. There is a degree of inertia within the institution. They started the easing cycle. It would look quite challenging to stop halfway and before they think they have gotten to a neutral rate of interest rates. And then I think let's talk a little bit about this idea that the Fed has, that the level of interest rates right now is very restrictive, and therefore, in order to manage the soft landing, we need to keep easing monetary policy. The information we got today from the core control group retail sale points to a very resilient U.S. consumer. And we keep getting surprised by this resilience. But if you look at the labor market, that's supportive for the consumer. When you look at the equity market and the wealth channel, that's supportive. You have home prices that have not lost value. And then you have the stock market doing well. And then, but those have been sort of with us for the last year and a half or so. What's also new this year as a tailwind is that with inflation coming down, real disposable incomes are also supporting the consumer and consumer spending. So then I'm quite curious to see what this latest estimate of retail sales does to the GDP tracking for the Atlanta Fed, the GDP now, because that was tracking about 3.3% before this morning's release. Now compare that with the Fed's estimate of potential growth, which is 1.8%. The U.S. economy has been growing at about 3% throughout this year, which is significantly above estimates of trend growth. And then the Fed thinks that neutral rates are below 3%. Something has to give. It's either growth potential is stronger or actually real interest rate or neutral interest rates in the U.S. economy are higher. And I think this is what the Fed will have to grapple in 2025.
Blerina, one of the reasons why it's been so confusing is it's not one story, right? It's the goods story, it's the services story, it's the high-end retail consumers, and it's the low-end retail consumers. Do we have a sense, just looking at the retail sales numbers and the retail reports that we've gotten over the past few weeks, do we have a sense, Blerina, about whether the spending right now is strong because of wealthy consumers or whether it's broadening out in terms of who is spending money and who has that capacity to do so?
And this is a very interesting question, and we have had this continuous rebalancing in the economy. We overstretched in terms of goods spending immediately post-pandemic. Then we had some payback in goods, and then growth shifted towards services. And I think in every report, you will find outliers. You'll find something that was driving retail sales higher, and then it's going to reverse the next month. But then what we see is then the following month, some other category is bouncing back up. So I think we take a step back and look at the data in aggregate. I think the U.S. consumer continues to spend, and a lot of that is not even coming from leverage. Now, we've had pockets of weakness, and I think affordability for the lower-end consumer has been a challenge. What seems to be different in this economy is that job availability and vacancies in the labor market have been so high that people have been able to find and add hours to their work week, and I think that's been quite supportive across the board.
Blerina, then what does this mean for, I mean, Jonathan opened up asking why should the Fed be cutting? Do you think there's a chance that we'll have more individuals dissent on this idea of cutting in December?
I think this is possible, but it's not my baseline. The one dissenter in the September meeting, Governor Bauman, she was dissenting on the principle that we shouldn't start the easing cycle with such a big bang. But I think since then she's fallen in line with the rest of the committee. I do think that Chair Powell wants to show a united front, so there might be a compromise here where they go ahead with rate cuts this week, but then they signal that they slow the pace of easing. And so that's giving reassurance to the hawks that they will respond to data as they come along, and they will have more time to decide whether a cut is appropriate in January or March or at the April-May meeting. So I think my baseline is that after December, the Fed takes a pause at the January meeting, and perhaps they shift to an every other meeting schedule. But if the data keeps coming strong as it's been in the last few months, there is a possibility that this becomes an extended pause.
That seems to be the consensus view going into 25. Blerina, we've got to leave it there. Blerina Uruci there of T. Rowe Price. Lisa, this is a conversation we can't have with guests, so I'll have it with you. At some point next year, some people on this committee start to audition for Chairman Powell's job.
Basically, there's this expectation come 2026, Chair Powell is not going to be there. That presents a problem because this is a Fed chair who has tried to really maintain, I don't want to say control because that's not fair, but true leadership in terms of saying, OK, guys, we're now doing 50, everybody get on board. And so how much does that really start to see a splintering? Although really, you have to kind of think they'd have to want to outdove everybody else.
Well, I already heard from a viewer today who said they can't believe that we've not heard from the Trump transition team, and maybe we will after the Fed does this cut, that all of 2024, before Trump sets foot into office, the Fed will have cut 3 times, and potentially they're talking about not touching the cut lever in 2025.
These changeovers are important. If you remember, they started the hiking cycle quite late. And there was a former official of the committee who suggested that it was because they hadn't decided the leadership of the Federal Reserve, that they were dragging their feet on hiking interest rates all those years ago. So I think these things matter over the next 18 months.
Are there people who are going to hinge their decisions based on the political favor it might curry or not? Chair Powell, I would argue, probably won't do that again, considering that he probably will not be up for re-election in 2026.
Mike McKee has plenty of things to say. Mike McKee, the consensus view into tomorrow is cut interest rates. Into January, it's skip. Does that line up with the communication that you've heard from Fed officials over the past few weeks?
The first part, not the second part, John. The Fed officials made pretty clear going into their blackout period that they were willing to cut this time. They feel they are restrictive. And if you look at the underlying credit issues, credit charges in terms of like credit cards, car loans, home loans, they are barely down from when the Fed started the cutting cycle. But do they pause in January? It's a really hard question, and I'll give you a good example here. We're looking right now at a November number that isn't very good for department stores and people like that, and is very good for non-store retailers, up 1.8%. But Black Friday was the last Friday of November, and Cyber Monday actually took place in December. Thanks to Drew Mattis for pointing that out to us. And if that's the case, then these numbers aren't really telling you anything about November, and it's really hard to know what it means for the economy. And if I don't know, the Fed doesn't know, we're all going to wait until we get into January and get some more numbers before they will start to lean in one direction or another.
People like Drew are selling bonds again. Yields are up by 3 basis points, 443 on a US 10-year. Mike McKee, thank you, sir. Going into that Federal Reserve meeting a little bit later on today, and of course the decision tomorrow afternoon. Joining us around the table, Amanda Lynam of BlackRock. Amanda, it's good to see you.
Good morning. Thank you.
You've said this a few times, and I'm so pleased you say it on repeat. Growth is key here.
Yeah.
If the Federal Reserve is skipping because growth is good, great, I'm buying credit. If it's because inflation is sticky, I might have to have second thoughts. Is that how you think about 2025?
Absolutely. The one thing that we'll be watching for at the press conference is what happens to the committee's estimate of the neutral rate. I think that's really what's key into 2025. We've already had a range of commentary from Fed officials about maybe we're not that far from neutral. And that is something that I think will just determine the landing zone of where we end up. But to your point, if we land at a structurally higher level of rates, because growth is, as Blerina said, well above trend, that is a backdrop that corporate credit can digest. And actually that translates into a really positive technical tailwind on yield-based demand. But if it is because inflation is reaccelerating, and especially if that scenario would be coupled with weaker growth, that's a much more negative backdrop for credit.
In the equity market, valuations, forward multiples are elevated. A lot of people would come on the equity side of the story and they would say that's kind of meaningless going into next year. It doesn't have to mean anything for the performance of 2025. Are there more difficult reasons to say the same thing about credit?
I think at a high level, we would characterize it as our title of our outlook is cautiously optimistic heading into the first quarter. There's an opportunity cost to being materially underweight corporate credit risk. We saw that in 2024. 2024 was a rally led by the lower quality portions of the credit market. I just think you need to be very clear about why you're buying credit in 2025. We're recommending to investors buy it for yield, buy it for carry. Don't buy it because you think spreads will tighten materially, and don't buy it because you think rates are going to fall dramatically. Both of those kind of tighter spreads and lower rates would boost total returns in the typical way through the duration exposure. This is a very nuanced argument. So we're actually quite constructive heading into 2025, but recognizing that it's really for yield-based demand.
Which really raises the specter of giving up liquidity for more yields, right? And this is the reason why private credit's been expanding so much, because if you want just the yield, you want the income. It doesn't matter how quickly you can trade it and at what price you're going to be trading it for. How much do you expect that to actually turbocharge an expansion that already has been dramatic?
Sure, and it's a great point. Even an extra 150 or 200 basis points for institutional and retail investors is meaningful meaningful when you kind of compound that over time. We think that private credit has a lot more room to run in terms of its expansion, both the addressable market of borrowers that are using it and the addressable market of investors that are participating in it. So I do think that in an environment like this where you are focused on yield, a very attractive opportunity. The other point is the advantage of building in diversification in portfolios with floating rate exposures. Just given the uncertainty around the path for rates from here, we actually like building in floating rate exposures, whether that's in liquid credit or in private credit. Most of that happens to be floating.
BlackRock put out a report, your team put out a report basically saying that you expect the private market sphere to increase to the share. It's about 30% of the overall share of credit in 2030 from about 20% currently. I'm just wondering how much this changes the dynamic in public credit markets. How much the yield level looks very different now than it has in the past, because in some ways the private credit sphere is underpinning it, and basically sometimes weaker credits even get funded privately and not in public markets. The public markets look actually like they're a lot more creditworthy than they have in the past. Is that the case?
Sure. So I would say we see three pillars. We see the banks, we see the public debt and equity markets, and we see private markets as providing a wide range of financing opportunities to a wide range of borrowers. We think on net that's a positive for financial stability. I think the key distinction that you're pointing to is that for a given borrower with a given credit quality, actually they may be better placed to get funding from the private markets because they're not contending with some of the technicals that exist in the public markets. Very nuanced discussion, but CLO rating constraints, distressed investors pushing for a restructuring. Those are things that a company really needs to be ready for in the public domain. If they're early in their growth stage, if they're anticipating that they're going to need more flexible funding, actually the private markets would be a better option for them. It doesn't mean that they're lower credit quality. It just means that they can benefit more from that financial flexibility, and they may not want the noise in some degrees that you might encounter in the public markets. I would say the punchline, though, is we see an opportunity for all three of these markets, bank lending, public debt markets, private debt markets, to coexist peacefully. And that's what we're seeing in the market.
You also note that private debt isn't just an American phenomenon. Where is it broadening out?
It's broadening in areas that are currently more reliant on the banking system. So Europe and Asia have a long way to go in kind of growing that private markets financing. Actually, this has been something that President Lagarde has been talking about, the establishment of a capital markets union, funding innovation in Europe, boosting lower productivity in Europe so that it can kind of close that gap with the U.S. I think that actually the private markets have been a really important tool in financing innovation in the U.S. market, and that's something that we expect to broaden outside of North America.
You also have an interesting point where you went through a bunch of companies talking about tariffs for next year, thinking about what happens next year in terms of policies. What is the main takeaway and base case of these companies?
The main takeaway is actually a theme that we've been highlighting, which is dispersion but not widespread market disruption. I would highlight two really interesting things. One, companies made it very clear that they've been preparing for this for years, whether that was because of the first Trump administration or the pandemic. They've been building in resilience in their supply chain, even if it costs more. The other thing, which I have to say wasn't obvious to me until we did this review, some of these companies actually expect to benefit from supply chain disruptions. Take off-price retail, for example. They actually said that a supply chain disruption could disrupt inventory patterns of traditional retailers, and they may take advantage. Just makes the point that this is not kind of a one-size-fits-all approach, that we really do have to do granular credit work on this.
Just quickly, the maturity wall.
Yes.
How many bricks did we take out in 2024? Are we in a better place?
Yeah, I think if we have spread widening next year, it's not going to be because of a payment shock or maturity wall. It's going to be because of some sort of macro event, tariffs. The corporate borrower sphere has been so incredibly proactive at managing that. It's been incredible.
We can survive through 2025?
Absolutely. Yes.
OK, good to know. Amanda, thank you. It's good to see you. Thank you. Amanda Lynam there of BlackRock on the credit markets going into next year. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Another tech CEO has made the trip down to Mar-a-Lago to meet with President-elect Donald Trump. People familiar say that Chris Marszalek, CEO of crypto exchange Crypto.com, met with Trump on Monday. The two discussed appointments related to the crypto industry and a national Bitcoin reserve, the People said. He follows Coinbase CEO Brian Armstrong, who reportedly had a call with Trump last month. Booking Holdings says the impact of inflation is still dampening travel demand within the U.S. In an interview with Bloomberg, the Booking CFO said that customers are still booking U.S. vacations more last minute, especially compared to Europe travel. The CFO added that demand in the U.S. was overall lower than anywhere else that Booking operates. And turning to sports, the Minnesota Vikings won their 7th game in a row last night after defeating the Chicago Bears 30-12. Minnesota was led by wide receiver Justin Jefferson, who had 7 catches for 73 yards, including 1 touchdown. The Vikings clinched a playoff spot over the weekend and now find themselves tied with the Detroit Lions for first place in the NFC North with a 12-2 record. The Lions and Vikings will play in the final week of the regular season in what could be a decisive game. That's your brief, John.
Danny, thank you. Thanks for the update this morning. Appreciate it. Up next on the programme, setting you up for the day ahead and counting you down to a Federal Reserve interest rate decision. The opening bell is about 36 minutes away. Equity futures on the S&P doing OK. We're negative across the board. On the S&P 500, we're down by about 0.4%, with some morning movers. Let's cross over to Manus Cranny. Hey, Manus.
Jonathan, keep an eye on NVIDIA. Will the bottom feeders come in and pick this stock? We're in a correction territory. Satya Nadella over at Microsoft, the killer line. I am not chip supply constrained. We assume that they're one of the biggest customers of NVIDIA. Power, yes, he's got a problem getting power, but this is in correction. Do you step in there? Broadcom, one man's misery is another man's bid. 38% in 2 days. This is their NVIDIA moment, according to some people out there in the market. May 2023. We give a little bit back at the moment on Broadcom, but it is up 38% in 2 days. I'll leave you with a flush on Tesla. You spent time with Dan Ives. I won't reiterate all of that. Autonomous is worth $1 trillion. The Trump White House access, power, access equals the next 4 years a total game changer. Hence the reason why every single tech CEO in the world is either having dinner or giving $1 million to inauguration. Jonathan.
Almost said it, Manus. £1 million. Feel the same way.
Oh, my God.
Pounds aren't worth what they used to be worth.
Oh, boy. We're in that kind of morning.
We
are in that kind of morning.
We are together.
We are together.
We are together.
Talking about pounds and those good old days.
Pounds sterling.
Yeah, exactly.
Back in my day.
Yeah.
No, anyway. Counting down to the opening bell. Here's the trading diary for the week ahead. The Fed's final meeting of the year kicks off today. And tomorrow, the Fed rate decision drops at 2 p.m. Eastern Time, followed by a Chairman Powell news conference at 2:30. On Thursday, another round of jobless claims and rate decisions from the BOE and BOJ. Plus, we'll get some earnings too, so look out for that from FedEx and Nike. And on Friday, core PCE and UMich consumer sentiment. Lisa, we are almost there.
Yeah, and this to me is going to be a fascinating week where you either reconfirm this idea of sticky inflation, a Fed that's coming around to that, or potentially we have another dovish surprise, because that tends to be what happens when Fed Chair Powell takes the podium.
Whatever it is, resilient U.S. consumer continues to show up time and time again. Also, I think the Trump administration incoming would accept it in pounds. It would be $30 million more. I just did the conversion.
To what, sorry?
If you were going to do 100 million pounds for $100 million.
OK. All right. Thank you for that. All right. Coming up tomorrow, Julian Emmanuel of Evercore ISI, Neil Dutta of Renmark, Victoria Fernandez of Crossmark, and Priya Misra of JP Morgan. Need to get to the weekend bad, don't we? Need to get to the holidays. Get to 2025. What are you talking about? I haven't been on vacation. 2 days back.
I know.
Let's wrap it up.
That's it.
Let's go.